It's October 13th, 2020, and we call this meeting of the Montana Board of Investments to order. The meeting is being recorded. So everybody, please take note of that. And can we have the roll call, please?
Good morning. Carl England,
Here.
Mark Nonig. No, Mark was here.
Mark's here, but
Working on my mute. Oh, I'm here. Sorry. Thanks.
Jack Prothero,
here.
Terry Cohe,
Here.
Bruce Nelson,
Here.
Diane Fladmo. I know.
She'll be joining in a moment.
Perfect. Maggie Peterson,
Here.
Jeff Greenfield,
Here.
Jim Edwards,
Here.
Senator Thomas. No Senator Thomas. Representative Hamilton.
Here.
Okay, we do have a quorum.
All right, all present, count for except for Senator Thomas. Dan, do you know, was he planning on joining us?
I don't know, Lindsay, did we hear from him?
I did not.
Okay.
All right, thank you. We've got some minutes to approve. Let's deal with the August 18th, 19th regular board meeting. Any additions or corrections to this new format for our minutes? Short version?
This is Jack. It says call to order, Carl England. I don't think you did that.
No, I didn't. We'll correct that you called the meeting order as the acting chair, correct?
Correct.
Anything else? With that correction, is there a motion to approve?
I so moved.
All right,
This is
Terry,
Jack, I'll second.
Terry Coe moved and Jack second. Any further discussion? If not, all in favor of the approving the corrected minutes, say aye.
All right.
Aye.
Any opposed? Motion carries unanimously. September 16th to 2020 special meeting minutes. Any additions or corrections to those? Hearing none, is there a motion to approve?
So moved, Mark.
Mark moved.
I'll second Bruce.
Bruce Nelson seconded. Any further discussion? If not, all in favor say aye.
Aye.
Aye. Any opposed? None. Motion carries unanimously. Administrative business audit committee reports. Maggie, you're up.
I'm up. Thank you.
Okay.
The audit committee met this morning and let's see, where do I want to start?
You know what, Maggie, before you do, did I do the public comment stuff?
You did not.
Well, I should, shouldn't I?
Yes. Phil.
Yeah.
Well, I apologize. Is there any public comment on issues within the board's jurisdiction? So hearing none, I want to make one brief one, and that is that in honor of, or in recognition of the number of times that Mark in particular, but also Jeff has to do the drive to Helena, it was our great plan to have this meeting in Billings in person, but COVID prevents that. Mark, we were thinking of you.
Yeah, nice try.
And
Stronger memo to follow.
it's the thought that counts, right?
Yeah, exactly.
Right. Yeah, exactly. He said. Anyway. All right. Now let's go to administrative business. Maggie.
Yeah, I think all of the board was present, but I'll just go through things at a pretty high level. Legislative Audit Division has been pretty busy at the board with Board of Investment staff going over things, and they should be back the end of the month to continue with their field work. Julie's informed us that the draft UIP and enterprise statements and the draft annual report will be presented to the audit committee at the November meeting. I think it's important to notice that there were 2 non-trivial communications that have been presented to staff. And one was regarding a missed STIP entry for 1.5.
Securities lending entry.
Is it a, oh, I had STIP from this morning, so securities lending entry. And the fact that our video and audio meeting recordings were not submitted to LSD as required under statute. And actually, I think it's probably audio for sure, but anyhow, they weren't reported. Both of those have been taken care of at this point, fixed. And according to Executive Director Villa, there are some new policies in place to prevent these things from happening again. Julia informed us that the STIP confirmation letters that were sent out last time to the local government have now been sent out to the state agencies. There are about 350 of them. They do not need to take any action if there are no changes. We had a report from Wifley, and the draft Wifley report said that there were no exceptions. It was a clean opinion. I did ask them if there were any recommendations they would make, and they talked about the loan portfolio, but basically said it was outside the Wifley review. Is that it? Yeah, I think that's it. And the committee did make a recommendation to approve the draft SOC1 type 2 audit. So I would make that motion to approve that draft, and the final would be approved in November.
Okay, is there a second?
Second. Jeff.
Jeff, is that you?
It was Jeff.
Okay. All right, and I noticed that we received that today. And we won't approve it finally until what, in November, is that right?
November.
Okay, all right. Any discussion on approval of the draft? If not, all in favor say aye.
Aye.
Any opposed? Motion passed unanimously.
So the last thing on my report is Executive Director Villa had informed the board that they had sent data to Heidi Bailey. Heidi Bailey, in accounting, right?
Yep.
CPAs. So that they could run what I would call a parallel report financials. And in the future, we may make recommendations to use them for our financials. That's my report, Mr. Chairman.
Okay. HR, Terry, you want me to do this or?
Please.
Okay, well, I chaired the HR committee this morning. Terry is recovering well from some surgery, and we're happy to have her back. But the HR committee, as you all know, because I think you were all present, had a long discussion and went through the staff evaluations, which were well prepared. We thank the supervisors for doing them. And then we have 2 action items. The first is a recommendation from the committee that Aaron Creppen be hired as the Director of Operations pursuant to the employment agreement that was given to the members of the board earlier by mail earlier this week. And I'd make that motion on behalf of the HR committee.
I would second that, Mr. Chairman.
Okay? Any discussion? If not, all in favor say aye.
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 Any opposed? None. The second one is that Thomas Winkler be hired as an exempt investment analyst pursuant to the employment agreement that was provided to the board earlier. And I make that motion on behalf of the HR committee.
I would second that, Mr. Chairman. This is Maggie.
Okay, any discussion? If not, all in favor say aye.
Aye.
Any opposed? None. But that's the report of the loan committee, and I think it's important to note that we have made 2 promotions, both from within, which is always a nice thing to see. Unless there's any other comments from any of the members of the committee, Jack, we'll turn it over to you for loan committee report.
Okay, thank you, Carl. The loan committee met earlier. We approved a loan to Madison County to repair roads in the Ennis area. The loan amount was $1,500,000, and it's a 7-year loan. That can be approved by the loan committee. We also looked at an IRP loan for the Montana Business Assistance Connection here in Helena. And staff approved a loan for $250,000 to them. And then also the committee looked at 2 additional approved in-state lenders for the in-state loan program, First Security Bank of Deer Lodge and Great Falls Development Authority. I think we're covered by the loan committee approvals on those and don't need any further action from the full board.
Okay, anything additional?
That's it for the loan committee, I think.
Okay. Jeff, do you want to make comments from, as our board member is also a board member of the Teachers Retirement System?
I do, but I think Maggie would really like to go first. So she tells me anyway.
All right, then, we try and do what Maggie tells us to.
I was really excited today to talk to everybody. So, we met last Thursday, the Impera board, and we had a presentation of our evaluation results. So I'm just going to give you a couple things on that. One of the things that's important to notice that the market asset returns for the year were 2.68 versus the 7.65. That's the assumed rate of return. But the actuarial asset return, which is based on a smoothing methodology, was 6.97% versus the 7.65. So what happens is the funding ratio decreased for sheriffs, highway patrol, game wardens, and PERS. PERS went from 35 to 36, I think. I don't have it on top. Oh, 36 to 35, excuse me.
For amortization.
For amortization period, excuse me, for the unfunded liability. And they increased for MPORs, FERS, judges, and the voluntary firemen. So that took us into talking about the legislative concepts that we wanted to bring forward. And there were 3 of them, which would be as required under statute because their amortization period is over the 30 years. It would be PERS, game wardens, and highway patrol. One of them was pretty interesting because our concept, and I don't know if I should be talking about it, but I'm going to, was to take some of that gambling money that we're generating from sports gambling and help fund one of these systems. So anyhow, the actuary also talked about a new mortality publication of a new mortality table that they're going to be using. And it's kind of interesting when you look at PERS, instead of being a 35-year amortization period, it would go up to 45. So that's a little scary for those of us that are on the repair board. So, let's see, what else did we did extend the contract with our actuaries, and we had some audits, which, the audits really aren't as important to this group, but it does impact the funding at some level because some of the things that aren't happening at the employer level. So our auditor talked to 15 employers. Of those, 4 of them had no findings, but 11 had some findings, at least one. And the vast majority of those, again, were the optional retirement membership. And as a reminder, if you work less than 960 hours, you don't have to participate in PERS, but you could opt into it. And there were 65 employees at 9 employers who hadn't been given the chance to opt in, which does impact our funding. There were some unpaid invoices from employers. One of them owed about $15,000, pretty substantial for these small employers. There was one that was interesting, that one employer couldn't produce their records or time cards or documents to support the data that they'd submitted. So there was an audit recommendation that they adhere to policies, and they said they would at this point. But how can you audit something where, yeah, there are no records? Another interesting one, which is new to us, was the cell phone allowances. For instance, the employer would provide $50 regardless of the cost of the employee. Those weren't being reported as compensation, so no contributions were being made. Those have since been corrected, but they're not going retroactive, they're going forward. This is my favorite one. This is from last time. There was an employee who was omitted from being reported for over 2,200 hours of service compensation, and that has been paid with interest, so go plan. As it's coming. Go ahead.
Mr. Chair, if I could just ask, any update on the peer review case?
It's still out there. As you know, Judge Reynolds retired, and they appointed Ed McLean, but it sounds to me like he's only going to pursue the criminal cases at this point because they're time sensitive. So we're waiting.
Okay.
As a matter of fact, I think Reynolds was on almost every case we had.
Okay.
That's my update. Any questions of me?
Can Jeff go now?
Carl. I just wanted to feel special, okay?
Jeff, TRS?
Thank you. Yes, well, Maggie is special without a doubt. We met on Friday, last Friday, the 9th, the day after Impera did. We share the same actuaries, so we received our valuation as well. I know next month the directors will be here to give full reports, so I will be brief as well. We had similar results. Of course, we didn't have the 7.5% return. Our return is slightly different, mostly because of cash. Our actuarial asset return was actually 7.0% instead of 7.5. So that will be smoothed in with the losses over the next 4 years. With that, we did come out with actually the same number of years to pay off unfunded liability. So 29 years last year, 29 this year. Our normal cost actually went down very slightly, approximately 0.03%, because of the changes in assets. I would point out also that every 2 years we have an issue with MUS system going from required to be in to optional to not an option. Supposedly the intent of the change was to have it paid off by 2037, might be 3037. Currently we're at 4.29%. Actuaries have calculated to actually pay that off by 2037 would be about 14.9%. So we'll be bringing that to the legislature. Maggie mentioned a different mortality rate tables. Ours actually give the opposite result of Impera. With the new tables, our time frame for paying off that unfunded liability would go down by 2 years to 27 years instead of 29. Our clientele tend to work apparently longer, so they don't retire right at 25 years that they can. I was looking at retirement applications for this year and was thoroughly impressed and surprised. There's a 50-year service that's retiring. There were 20 plus individuals that had more than 45 years of service that were finally retiring. Equal number of 35 to 40 years. Just they work a long time, just the way it is. You may recall also that there is a second tier now of retirees. Their normal cost is about 0.5% lower than the tier one normal costs, 1.43%. So those are the highlights. I think certainly not bad news on any front. Would have been better had we been able to reach that actuarial 7.5%, but clearly things happened everywhere, not to the good. And I think we came out okay. One of the other things that we did as a board, sometimes we need to hear what are called a contested case. So the TRS makes a determination of the retirement benefits. Sometimes individuals disagree. Have the right to take that to a hearings officer. We do have one of those currently out of Missoula. We heard arguments from both TRS and this individual's counsel. And at our next meeting, we'll have to make a decision based on the hearings examiner's determination and whether we agree with that or not. And that is my report. Thank you.
Thanks, Jeff. Any questions for Jeff or for Maggie? Seeing none. Board Legislative Liaisons, Representative Hamilton, I see you're here. So welcome.
Thank you, Carl.
Thanks for.
I would just cover one topic. Is pretty much what has been going on in the last month or so since we last talked. Month and a half, I guess, almost 2 months. And that is the revenue outlook is beginning to take a little bit more shape. September 15th, the Legislative Fiscal Division reported to Legislative Finance Committee their first real outlook. As I'd mentioned before when we last talked, there are strong fund balances ending the year. So that's helpful to kind of carry us into the following 3 years, really. In their outlook, they said through the end of fiscal 22, we look pretty good. We're ending fund balance in fiscal year 22 would be about where it needs to be, kind of the minimum.
Yeah.
23, perhaps we have a little bit of an issue there. Contributing factors to that are there are a couple provisions in the CARES Act that will reduce our revenue if we don't decouple from that by quite a bit. There's the elimination of the requirement for IRA distributions for those who are over 70 and a half, and that hurts our revenues somewhat. It's a little bit of income shifting, people moving income around to take advantage of the losses that they might have in 2020. And some additional taxpayer behavior, the estimates they pay, whether they're going to take their estimates back and use them as refunds and so forth. So we have an unusually large number of volatile items this time, making the ability to predict the revenue perhaps less than it has been in quite a while. With the original prediction, we think HJ2 revenue estimate, the baseline in 2021 will be about 274 million less than had been expected. If we come out with the optimistic version, that's still 127 million less than expected. So once again, the variation is quite high. There is expectation of increased revenues over the previous year in 21, 22, and 23 at this point. One quirky thing I mentioned in last report is withholding, which is the largest ingredient of personal income tax, which is the largest ingredient of our revenue, is holding up. It seems to be right in line with 2019 so far. So we'll know more about that in the fall and further into the fall. And there'll be a new update, sort of the official update in November of the new revenue estimate. And then at that point, the impact of the CARES Act will become clearer to us. That's all I have for today, Carl.
Thank you. Any questions? And I don't see that Senator Thomas has joined us, so. Yeah,
Carl,
Mark.
Yeah, I just wanted to ask Representative Hamilton, can you give us an update, if you know, on plans to conduct the legislative session, remotely or whatever.
I think the best update I can give you on that is it's a mess right now. There have been various attempts to make it a all in-person session. There have been attempts to make it an all virtual session. I think both of those are unlikely to occur. So I think what we're going to end up with is a hybrid session where we'll have some people in the Capitol and some people will be on Zoom. We'll know a little bit more about that. Probably Legislative Council meets this week. Maybe they'll have a little bit more direction. More likely, we won't know until after the election.
Thank you.
Anything else? All right, so we move to tab 2. Dan, you're up.
All right, thank you, Mr. Chair. Members, you have the monthly snapshot. Just to put it in perspective, when I first arrived 2 years ago, our NAV was about 18.5 billion. We're now at 22, right around 22.5. So just what a change 2 years can bring. You also have the CARES Act report included. This is what we update daily. This is as of last Friday. The deferred payment program, I would put in the strong success column. We were able to turn $50 million or $44 million in funds awarded to $137 million in impact to Montana businesses. That is tax-free, unlike most of the other CARES Act programs. So these businesses will not have to pay any sort of income tax on that benefit. So very impactful program. Again, can't say enough good things about Doug and Sam and Herb, as well as our partners at DOR and DOT for helping us get that up, running, and a success. The working capital program, as we discussed a little earlier, a little bit of a laggard, and we knew that would happen heading in. All the businesses will have to pass underwriting by the various banks that they choose to participate with, and the banks will come to us. We are anticipating a bit of the, your final exam is, or your final report is due next Tuesday. You'll start working on it on Monday. Type behavior here, at least in conversations with the banks. There'll be quite a bit of activity in the next week or so. We had anticipated funding all at once in lump. We'll see what the applications look like. If we aren't able to process them quickly enough, we may have to trickle the money out. But again, $819,000 awarded with a benefit of $4.4 million. Good leverage, good support for the businesses. So very happy with that. Outside of that, just a heads up for the board, I've been requested to present to the State Administration and Veterans Affairs Committee along with Executive Director Graham and Executive Director Schwinden. We're very well coordinated, not only heading into session, but we've got our session strategy mapped out. We're ready for whatever comes our way, knock on wood, barring any changes. But we at least know what we're going to say, how we're going to say it, and who's going to say it. So I think this will be a very tightly coordinated legislative session, much like we saw last time. So very happy with that relationship and happy to answer any questions you have on anything.
Questions? Going once? All right. Is Ethan ready? We ready to turn to tab 3?
Emily's actually going to present this, Mr. Chairman.
Okay. Is Emily ready?
It's her swan song.
Yes, I'm ready. Good morning, Chairman England, members of the board. Today I want to talk to you about a recent investment that we've made, True America Workforce Housing Fund 1. The background here is that this past year, Montana has been actively seeking a vertically integrated multifamily private real estate operator that is focused in Class B multifamily housing. Class B multifamily housing is commonly referred to as workforce housing, and the rents are typically $300 to $400 per month less than Class A housing. We found what we were looking for in True America, and we made a commitment of $50 million to the Workforce Housing Fund 1. This commitment gives us Class B multifamily exposure with a manager who has a proven track record in the space. They have a vertically integrated multifamily value-add platform that originates, underwrites, closes, construction manages, asset manages, and reports on its Class B housing units. The firm was founded in 2013. Their strategy focuses on purchasing Class B multifamily assets and creating increased value through tailored renovations, repositioning strategies, and improved asset management. The firm is an experienced multifamily investor with $10.3 billion and over 43,000 units under management. True America built its track record over the past 7 years through nearly 100 distinct joint ventures with institutional investors, including insurance companies, pension plans, investment managers, and family offices. Important to our decision was the depth of experience of the True America team. The president, Bob Hart, has been investing in multifamily for over 30 years, and other senior members of his team average close to 20 years. The leaders of the firm are well known in the market, and this market presence gives them expansive market knowledge and assists them in identifying asset opportunities. The firm is data-driven and exceptional in its ability to harness extensive market and property data to use in its acquisition and asset management activities. We believe the firm is teamwork-focused, collegial, hardworking, has a great culture, and a positive reputation in the real estate space. I want to add that MBOI was offered, MBOI was offered compelling incentives to participate in an early closing of the fund, including no fees on committed capital during the investment period, a 1.4% management fee on invested, no fees on co-invest, and we will have a seat on the Limited Partner Advisory Council, and we've been offered the same fee structure for the next fund. And with that, I'll open it up to any questions, please.
Questions? So Emily, I have a couple. If nobody else does. So other than, I think you said 300 a month, what's the difference between Class A and Class B?
It's, they're targeting a different demographic. Class A has all the bells and whistles, a lot of the amenities, the higher rents. They're targeting, higher median income demographic versus Class B, as mentioned in my presentation, averages around 300 to 400 less per month. The amenities are a bit on the more standard basic side. You won't find, perhaps the racquetball court and, 3 different weight rooms at a Class B establishment, but you will find, a general gathering space, parking, more of the basic amenities are offered in Class B.
So it's an issue of amenities, not an issue of condition of the property?
The condition of the property, these are all institutional level properties. They're just not geared to be as extravagant, perhaps, as maybe a Class A property would be.
Okay. So the other thing I just had, and I've never seen, I don't know if I've ever noticed this before, I apologize. But down in the firm overview, you've got number of total staff, then investment staff, and then a team. What's the team?
Sure. So
there's 49 total staff, 10 of whom are involved in investments. What's the 10 what are the team?
Sometimes a firm will have a broader investment team, but maybe the fund is only utilizing certain members of the team to execute on the fund strategy. And here with this firm, their full investment team is they're all committed to the fund strategy.
I get it. I get it. I get
Great.
it. So that's 10 out of 10, in other words.
Yes.
Okay. All right. And then you talked about the incentives. How did they come about?
We established a good working relationship with the firm. They were very interested in having Montana participate in an early close of the fund. And we asked for incentives and were offered incentives to commit early.
You drove a hard bargain, Emily?
We sure tried to.
Well, thank you for doing that. Anything else?
Yeah, I've got a
Bruce?
question then. So there's Class A and Class B. Is there Class C? Are there other classes of multifamily housing?
Yes, there is Class C multifamily housing, which would be, more of your this lower quality housing for a lower demographic.
Okay, and then another follow-up question, if I could. Since this is a new outfit that we're doing business with, how comfortable were you all with the opportunity to do your due diligence under the circumstances right now with travel limited and all of that?
Great question, Bruce. We did extensive desktop diligence with this firm. I conducted Zoom interviews with many members of their team, but to remain true to our process, Ethan Hurley, our director of real estate and natural resources, and John Putnam, our CIO, they both physically traveled to Los Angeles to meet with the executives of the firm. They conducted a full day diligence session with them and walked away feeling very comfortable with the quality of the people that we were choosing to invest with.
Okay, thank you.
Thank you.
And Emily, how did the Zoom stuff go when you were doing it?
It went well. And, I would have 45-minute to an hour-long meetings. And, the team there was able to present to me and, walk me through their processes, view their systems online. It was actually quite efficient.
Good.
Yes.
Would you think going forward you could do some, or you could do some of that, even when times aren't as extraordinary as they are now?
I believe absolutely. The investment team is quite flexible in how they can conduct their diligence, and I'm confident that we will all continue to find ways to be efficient in our work.
Yeah, but so my question has to do with, I know in my work, there are things that work over Zoom really well. And I think that when this is all said and done, we're going to be doing things over Zoom that we used to do in person. We're going to be doing things over Zoom because we can schedule them within a few days, whereas scheduling travel took weeks and in some cases months. Do you think that in this line of work that's going to happen too?
I think it's definitely possible. But the discussions amongst the investment team and with John has been that, we continue to feel that there's a lot of value in visiting the firm on site and having some of that in-person interaction and meeting members of the team in person as well.
Okay. Well, thanks.
Welcome.
Anything else for Emily? If not, thank you, Emily.
Thank you so much.
All right, Dan, what's the pleasure here? We're 20 minutes ahead of schedule.
So I think we just take a longer lunch.
All right, we'll be back at 1 then.
Yep.
And now, are you delivering to Bruce and Mark and me?
As long as you like Pizza Hut and I can get my app ordered real quick, yes, we can do that.
Well, I'll forego it. Bruce, you ready? All right, well, we'll stand in recess until 1.
Thank you. Lindsay, we are recording.
Okay, and we are behind the tab that I took the thing out of, tab 4. To have some education on pension proxy voting by Dan Zarling, who is there,
I'm here.
climbing a mountain, looking good.
No climbing.
Okay, so Dan, I guess, unless, Dan, did you have any introductory remarks to make, or is it the floor Dan's?
Floor is Dan's.
Okay, Mr. Zarling, nice to see you.
Thank you, Mr. Chairman and board members. Welcome back from lunch. And I would like to start with an overview of proxy voting. Section 12 of the Public Retirement Plans Investment Policy addresses the exercise of shareholder rights. And it's there that it says the board recognizes that publicly traded securities and other assets of the plan includes certain ancillary rights, such as the right to vote on shareholder resolution at companies' annual shareholder meetings. And so the board has a fiduciary responsibility to act solely in the best interest of its members and beneficiaries when voting proxies.
Dan, can I interrupt you for 1 minute?
Yeah.
I don't think we got Terry back on the line. Dan, was she planning on coming back, or was she gonna?
Dan stepped out for a minute. I'm not sure. I haven't heard.
Can you check with her?
He's coming right now.
Sorry, Dan, darling.
Want me to keep going?
No, let's see what we can figure out,
Is Terry
if
coming
we're
back?
Terry or,
Terry should be coming back. She's not in the waiting room. We don't have anybody in the waiting room. Oh, she'd be under T. That would make sense.
Maybe she's having an extended lunch.
Yeah, we don't have Terry yet, but I can,
I sent her a message.
okay, we just sent her a text to let her know we're getting started again.
I hope it's the right number.
All right, should Dan continue then?
Dan, yeah, let's continue.
okay, all right, I'm sorry, Dan.
No problem. I'll jump right in. The right to vote proxies can promote economic and non-financial value to the board's members and beneficiaries. And the primary goal of voting proxies should be to maintain or increase the economic interest of the board's common equity investments. Proxy voting responsibility is delegated to the external public equity investment managers who have an established separately managed account. And proxy voting does not occur in other asset classes such as fixed income or private investments. Commingled funds are not under the board's proxy voting authority. Instead, the commingled funds investment manager has sole discretion to vote proxies. So typically a manager will utilize a proxy guideline that they've developed internally, or they're going to use the policy guidelines from a proxy advisor like Institutional Shareholder Services or Glass Lewis. And each manager who votes the shares of common stock is contractually obligated to document and report proxy voting results to staff. So before moving on to the proxy voting process, any questions or comments right there?
Please continue.
So on the next slide, the proxy voting season starts in January, and the investment managers' proxy teams are typically researching and engaging and preparing to vote proposals during the first and second quarter when the majority of shareholder meetings occur. And then the rest of the year, they typically are evaluating how the proposals were voted and how things went and whether they need to revise their voting instructions or anything like that. Company proxies and proxy ballots are delivered by the custodian or by Broadridge Financial to the investment manager. And the investment manager is going to use a third-party proxy voting platform. Again, that's ISS or Broadridge, to electronically vote according to their proxy voting guidelines or instructions, which they make those available to the staff. And proposals that are not covered by the policy guidelines are referred to the manager's proxy team or their committee to evaluate on a case-by-case basis. So investment managers cannot simply vote without adequate examination of the underlying issues. And sometimes they take it to a committee to look at a specific issue and research before they make a vote. And the investment manager has internal resources and third-party advisories to research and analyze and the cost benefit of voting on proposals. And the research and analytical skills of the investment manager can be very effective in corporate governance issues. And it is believed that good corporate governance and good investment decisions go hand in hand. Now, the proxy voting advisors, which again, ISS, Glass Lewis, or there's some others as well, have developed public pension policies to guide proxy voting decisions. And the public pension guidelines are designed to ensure compliance with specific fiduciary responsibilities of public pension plan sponsors in voting proxies on behalf of public employees. And the guidelines encourage typically increased reporting and disclosure on the part of portfolio companies, including executive compensation, governance, human capital management, and environmental practices. ISS and Glass Lewis, they will evaluate their public pension guidelines on an ongoing basis and formally update them on an annual basis as issues come up with shareholder proposals. And the public pension guidelines can be also customized according to a plan sponsor's specific interest or focus. But nearly all of the ballot proposals can be voted on using rules and instructions based on a public pension guideline. Directing investment managers to use a common public pension policy will ensure that proxy votes are consistently voted according to the board's fiduciary responsibilities or our wishes. And that's what's under consideration right now. But let me move to the last slide, which is showing you the proxy voting results. And it's to give you a sense of the large number of proposals that you need to track and vote on each year. So back in calendar year 2019, there was 165 million of these individual proposals that needed to be voted on. And there's a variety of reasons why proposals might not be voted on, but it's a very small percentage, under 1%. It's sometimes there's trading restrictions on the international market. Sometimes it's shares on loan. It can be because the investment manager did not have a strong opinion on that particular proposal. Or maybe the worst excuse would be that they weren't prepared to make an informed vote. But nonetheless, the proxy voting profile of our passive investment managers who have the majority of votes is shown here in a very simplified view. And I'm breaking these proposals out either coming from management or coming from shareholders. And it simply shows that most management proposals, over 80%, are voted with management. And that's typically on routine matters. So that makes sense. And you will note that shareholder proposals are increasing, but only 17% are voted against management, which management is typically against shareholder proposals. So that 17% is telling you that whoever voted, they're voting for that actual shareholder proposal. And these typically are asking either for more disclosure or policy changes. So if a shareholder proposal gets over 50% of the vote, management is going to have to abide by that new shareholder requirement. Otherwise, if management can demonstrate that they already meet that shareholder proposal, then sometimes that shareholder proposal will be withdrawn before the meeting. And that typically happens when some of these large firms are engaging with the management teams, trying to bring about, better corporate governance or better disclosure. And then again, there's some slight differences in voting here because you can either withhold votes or you can abstain from vote or you can just simply not vote. That can influence the outcome of the voting. But I'd like to stop there and just ask if there's any questions or anything I can clarify there.
Yeah, Dan, Mr. Chairman.
Yeah.
Yeah.
Dan, can you give us a specific example? If I'm reading this correctly, and maybe I'm not, 17% of the time, our passive managers cast those ballots in favor of a shareholder proposal that was against management. Am I reading that correctly?
Correct. And so the one example would be executive compensation. There
Okay,
would be a shareholder looking for additional disclosure, or they might think that there needs to be revision to the executive compensation and have tighter links to performance. And so sometimes the passive managers or others will vote for that shareholder proposal, and that's going to show up as that 17%, because management is typically says we're okay with shareholder or executive compensation. Does that make sense?
yeah, that makes sense. How often are those successful? I mean, this shows how often our shares might have been cast against management, but how often are those successful? I mean, occasionally you hear about them in the news.
Correct.
But
right, and that kind of goes into the feedback loop of the everyone trying to evaluate how the voting went. It's not very often that these shareholder proposals get through because they have to be over 50% typically to take effect. All I can generalize to you right now is it's a very small percentage, but it's growing, and the number of shareholder proposals are growing, and there's been an interest in certain areas that you are seeing an increasing number of votes, and that's where that dynamic comes in, where most management teams don't want to go to a shareholder meeting and be surprised by something being voted over 50%. So they might take some initiative and have it removed, or let whoever proposed it to say, hey, we're meeting this requirement, you really need a vote on it. So go ahead.
if you don't mind, Mr. Chairman, just one more follow-up.
Please.
So I don't recall talking about this before, but again, I might have not have that good a memory the last year and a half. But do we have then a policy on how we advise or whatever we do to our passive managers, a set of policy guidelines to instruct them? Or are we in the process, or should we be in the process of putting something like that together?
Right. So we're moving in that direction of trying to adopt a policy or instructions based on what ISS has for U.S. public pensions. Typically right now, when we delegate the voting authority to our external managers, we are relying on their voting guidelines, and they disclose that to us and things like that.
Okay. So one more, Mr.
Go right ahead.
Yeah, to Becky and Mark, how do our counterparts out there have policies, or because obviously we're not CalPERS, but CalPERS is the one that gets in the news when they go after somebody in a proxy fight. So somebody out there in our world must have some guidelines for what fights they get in and what fights they don't get in.
Well, Mr. Chairman, and to answer your question, Bruce, this is something that is becoming a bit more common for public funds and other large investors to be a little bit more outspoken or directive to these proxy voting firms and how to vote the proxies for the plan. It is an important asset to the plan and to the plan beneficiaries, but in the past, as Dan was talking about, it primarily just went along with management proposals. Now in the environment that we're seeing with a lot of social issues, environmental issues, have become part of this discussion as well. In the past, proxy voting was directed very commonly by faith-based organizations, for example, that wanted certain issues voted along with their particular values. So it's not something that's necessarily new, but I would say there are probably more plans coming to the table with specific instructions for these proxy voting activities to align with the values that they feel are most important for their plan beneficiaries. So it is becoming more common. Jim and Mark, I don't know if you want to add to that from what you've seen.
Yeah, I would add that I would point to several things. One is on Dan's presentation, the sheer number of issues is phenomenal.
Oh.
So, it would be folly to think that you could have a policy that you could send to managers and it would apply to every single one of them. The breadth of proposals that can come from a shareholder under their proposal, it's mind-boggling how broad they can be. So a number of funds, and by the way, we should not assume that public funds all think alike on proxy issues. They don't. I can assure you that a teacher's plan in Massachusetts might look at an issue differently than a police and fire plan in Texas. So believing that there's a public sort of a consensus public policy for covering proxies is probably not likely to come about, but I could be wrong about that over time. The third thing is that most of the time, and I speak to big funds like CalPERS and our largest single AUM client, the state of New York, which has over $200 billion, they have proxy voting staffs. The last time I looked, CalPERS has 22 people that do nothing but this. In the case of the state of New York, I don't know the exact number, but it's probably between 7 and 10. But there are two lines of approach when a shareholder, an asset owner like yourself, wants to influence a proposal at a company that is where they don't want to simply accept what their asset manager would do. And that is, one, they engage the company directly. And you referenced the CalPERS being in the news. They have a unit that does that, as does the state of New York. And even some smaller funds do that, but it's highly selective. And the other thing is that sometimes they have a policy that will be very narrow, but on something important to them. For example, they may say, we don't like 2 classes of stock with differential voting power. So we always vote against those because no matter where they come up, we don't like them. And so that's only a small segment of that 165 million proposal number that Dan gave you, but it is something that you can look at and say, there are no circumstances where we like that. Most of these types of proposals, you can't do that, but there are some that you can. And those are the kinds of things that if you decide down the road to put together a policy, those are the things where if you can find something to say, I can't think of a single instance where we would support that as the part owner of the company, then maybe that's something that's relevant to a policy. I know I ran on there a little bit, but you asked a very good question and I thought I'd try to round out the answer. I'll stop there.
Sorry, somebody else wants to jump in.
Go
But
ahead. You're on a roll, man.
Becky, Jim, Dan, it seems to me that there is a little headline risk here for us in this, in that if we totally always leave the decision up to our asset managers on how to cast proxies, that there could occasionally be a time when somebody would figure out that some assets being managed on behalf of our primarily pension recipients in Montana were cast in a way that Montanans might say, hey, we don't like that. What the hell were you doing? And especially if it was a decision made by somebody else without any overall guidance from the Board of Investments. So it just seems to me there's the potential for some exposure here.
You are correct. There's always the risk that a manager will vote a proxy that in some way offends one of your constituencies. There's territory, but you might also say that any of your managers might buy an interest in a company that would upset some part of your constituency. So I don't know that proxies are necessarily different than actual purchases of sales of stock in terms of headline risk. Dan, I don't know if you agree with me on that.
Yeah, there is typically a common starting point for these proxy guidelines that the manager is using to vote. And so a lot of times you can tie it back to, again, their ISS benchmark policy, or Glass Lewis has a benchmark policy. And you might get some differences where the investment manager has a particular focus on some of these shareholder proposals. And it's just becoming more common that, say, BlackRock wants to make more noise about how they voted against management on the so-called ESG, or in particular the environmental and social issues. But they always come back to the idea that their committees are voting these things in the best interest of their clients, and almost all of their clients are either pension and Taft-Hartley, and both of those are going to be closely following or complying with the RISA guidelines when they vote. They certainly don't want to get tripped up in that area, and that's kind of the summary level of where you see differences is if someone is voting, say, outside of kind of ERISA guidelines.
So let me give you an example of something that has come up, but that asset owners in a particular circumstance were split on. JP Morgan. There are some asset owners that believe, and some advocates that believe that the CEO and chairmanship should not be held by the same person. In that particular company, that got put up for a shareholder vote, if I recall correctly. And actually the asset owners in that particular instance, even though there's probably a general view that it's better to separate the two offices, if I recall correctly, they actually voted in support of having Jamie Dimon be in both positions. It just goes to show that that there are some things that can be viewed by asset owners as black and white, and some things that are situation dependent, I suppose. And the other thing I'd say with respect to what Dan just said is that, you expect these managers to vote your proxies in a way that maximizes the value of the underlying stock, because because they get fired if they do things that degrade their performance. And so there is some alignment of interest between the managers and you with respect to proxies and the value of the assets. And the last thing I'll say on this is that headline risk is everywhere in this area. But the worst headline risk, going back to your question, is not to have monitored the voting policies by your managers at all. If you can show a track record that you did look at them and they made some general sense, that even if a constituency disagrees on a particular vote, you can demonstrate that in fact you have been active in looking at the overall policies that the managers use. I don't know if you agree with that, Dan, but I think that's probably the biggest headline risk, is not paying attention to what your managers are doing in the first place.
Right.
So in that respect, should we be looking at the ISS or Glass
Lewis.
guidelines and adopting them as board policy?
I think that's a valid consideration. And again, we're at least we're in discussion about trying to move in that direction of saying, can we effectively implement adopting ISS guidelines and have all of our managers adhere to those guidelines? It just takes some time, and it takes some, kind of that examination of their policy. So we've just done the initial work on that to say, can we even make this happen with our existing managers? So it's, I think it would be helpful in terms of making sure that there's a common voting across all of our managers, and that it just, it also helps that if we try to develop all of the guidelines internally, it's going to be overwhelming. And like Jim said, there's going to be some cases where your guidelines, a proposal is outside your guideline, and you have to deal with that. But it's kind of that cost benefit of how much time you want to spend with this and how much resources you have.
Okay. Other questions?
So Carl, I see under the last bullet point on page 3, maybe this is for Dan or for Jim or for Becky, I'm not sure. The ISS U.S. Pension Fund Policy Guidelines. I'm wondering if Glass Lewis has public pension fund policy guidelines, and why we would choose ISS. What is there about ISS U.S. pension fund policy guidelines that we like so far?
Right. So I don't think there's a big difference between the two. I've noted that other pension plans have used Glass Lewis in terms of adopting some guidelines. And then ISS has told me that they have pension plans that use their policy guidelines, and then they customize it from there. But, it's ISS is one that comes up on a routine basis with our investment managers. So that would be the direction that I would align with. But whether it's Glass Lewis or someone else, it just has to work for everyone.
I'll follow up, please.
Yes.
What's the timeline for getting information and having this done?
So currently the managers vote the proposals. We haven't given them, as Dan says, a specific, you're going to vote it per the US, ISS US pension policy. So this is where we're just taking a look at this and saying, do we want to give them all the same thing so we don't run the potential of people kind of voting differently? There's still that risk, as they've noted, because you can't really cover all things, but this would help to get everything in sync. To answer your question, the next 6 months, I think is fair. So there's some issues here potentially in terms of, can all of our managers do this? Do they all have a relationship with ISS? You know, there's those kinds of issues. We just haven't gone to all of them yet. And this is a contract thing. So we have this written into our standard contract that each manager will adhere to, you know, the policy. So currently it's a little more generic, I guess, if you will. This would be an attempt to constrain them a bit more. But it'd be a contract adjustment, and that will take time as well. So I'm not sure I have a great, answer for you, but let's call it 6 months to a year to get all of that done. Shorter time, I think, to understand that we want to do this. Implementation might take us a little while. And one last thing I would note per Bruce's questions, we don't sacrifice, so in each of our contracts, we don't sacrifice the ability to, if we as a staff board or something, if there were some issue that we just thought we've got to vote this way, we reserve the right at all times to go to our manager and say, you're going to vote this way regardless of anything else. I can never remember having done that, and I think it's somewhat of a slippery slope. As Jim mentioned, you've got CalSTRS or somebody like that with 22 people on staff doing this type of thing. I don't want to go there. We don't have that kind of staffing and time. This is the most efficient, best type of way to do it. We're taking another look at it that we haven't maybe done for a little while. To Bruce, to your point, we bring the proxy voting stuff to the board every other year. So you may not have kind of heard this discussion prior. So.
Okay. Well, it's interesting, and it is a difficult subject because of the slippery slope. But thank you, Dan. Well done. Thank you.
All right.
I think unless somebody has a burning question, we'll turn to asset allocation, real assets, and infrastructure education. Becky, Mark, Jim.
I'll kick it off. Yeah, thank you, Mr. Chairman. I'll kick it off, and then Mark is going to take us through the deck, which is tab 5, and you can see the table of contents on page 16 of your deck. I just wanted to give you a little background and high-level explanation for this presentation. We've had a series of really helpful conversations, video calls, conference calls with your staff and with John and Dan, as they thought about, as John was posing what kind of changes he wanted to bring to you in November for adjustments to the midpoints in your asset allocation structure. And those were very helpful conversations. We actually then created an asset allocation study to look at the impact of those changes to the midpoints. And so you'll see that presented today. Today is not a decision point, it's an introduction of what the recommendations are going to be for November. We have also recognized that in this midpoint adjustment is the addition of a classification of real assets for some investment strategies that you pursue right now in a couple of your other asset classes. And the proposal that you'll be hearing about more today is to strip out a couple of asset classes that really are helpful in inflationary periods and put them in a category called real assets, and then potentially add to them another investment category that Mark is going to be going through called infrastructure. You probably have heard a bit about infrastructure, especially in the last year or so. There's been more discussion. Sometimes it's linked with the stimulus that has been discussed for our economy and around the world, but it's really been a long-term need and investment opportunity that investors have considered. And that's part of our discussion today. So I just wanted to give you a high-level view of, number one, we've had a lot of collaboration with your staff. We've got an asset allocation study to show you the impact of those midpoint adjustments. And then also the chance to spend a little time in this off-cycle meeting telling you a bit more about the role of real assets, as well as one of the real assets that's newer to all of you, and that is the infrastructure category. So I will turn it over to Mark, whose background, if you didn't hear early in the call, is the Federal Reserve. So an appropriate background to be talking about asset allocation. Mark, I'll turn it over to you.
Great, thank you, Becky. If you go to page,
To the boardroom, Mark.
it is. I try to get themes now that kind of relate to what's going on, so hopefully this worked. But if you go to page 18 or page 4, I'm just going to be using the pages on the bottom. It's a little easier to follow. One thing we wanted to do first is just kind of rehash what is strategic asset allocation and why it is important. I know many of you have seen this before, but it always helps to kind of rehash what we're actually doing when we're talking about asset allocation. Off to the left, you can see the definition of strategic asset allocation essentially refers to a framework for constructing a diversified portfolio using asset classes that, as much as possible, have relatively homogeneous return and risk drivers. The benefits of asset allocation, I think the one you're most familiar with is when you have different asset classes that have return attributes that don't necessarily move in sync, that can produce a more attractive risk-adjusted return. When one goes up, you rebalance to the one that went down, and that can generate a more attractive risk-adjusted return. Another advantage, which isn't as often talked about, but is important, is you can leverage some of the advantages that you have as an investor. For example, if you have a particular edge in choosing small cap managers, even if at a high level, small cap may not look that much more attractive than large cap, if you have a comparative advantage that could justify a higher allocation than just kind of base case assumptions assume. So those are the two primary advantages. If you look to the right, you can see a pie chart that shows your current midpoint allocations for the different asset classes. You are very well diversified. And then the one we'll be talking about mostly today, well, really exclusively today, is the natural resources. And as Becky mentioned, the reclassification of that as real assets and slight expansion of that. Again, the formal recommendation is going to be coming in November, but this is kind of a preview and education. You go to page 5, the most important thing when setting a strategic asset allocation is really having a very deep understanding of what your investment objectives and constraints are. We've run through the key things that kind of drive this thought process at all clients, but also at MBOI. First and foremost are the financial objectives. Your most important objective here is to be able to have sufficient funds to cover future expected benefit payments and also keep up with the actuarially required return so that contributions don't have to be adjusted in a negative way. In terms of your return objective, we've listed the 3 return objectives in order of importance. Again, clearly the most important thing is to be able to generate a return that keeps pace with the actuarially required return for each of the plans. Secondarily, you do have a policy benchmark, which represents now it varies in your ability to nail this down accurately, but essentially mirrors the passive benchmarks to which you have exposure in the portfolio. So exceeding that is another objective. And then thirdly, and this is probably the least important, but it's something that is certainly important, particularly on the extremes to keep an eye on, is to rank competitively versus your peers that have a similar amount of assets and similar types of strategies. The risk tolerance that you have is kind of qualitative, but moderate to high tolerance for risk. If you contrasted yourself with a private endowment that doesn't have to worry as much about headline risk, doesn't have to worry as much about liquidity, you're probably not quite that high, but you do have an extended time horizon. You do have pretty good liquidity. You do have the liquid assets, but certainly not 40, 50%, which is something that sometimes you see in endowments. So you have a moderate to high risk tolerance. The things that do limit it a bit are some of that headline risk that we talked about, but more importantly, the liquidity needs of the portfolio. You do need to fund distribution payments to, on a quarterly basis or monthly basis. And you do have capital calls too that you need to be concerned with. In terms of your constraints, you're a very large institutional investor. There aren't too many constraints that you have. Probably the chief constraint in addition to liquidity requirements is the fact that at the end of the day, you have constrained resources, and making sure that you allocate them in a way that is expected to give you the most bang for your buck is something that's a constraint. Why don't I pause there? Any questions on just kind of overarching objectives that you have and just the high level concept of strategic allocation?
When you talk about constrained resources, are you talking about staff and facilities, or are you talking about?
Yeah, I mean, mainly staff. I mean, you can't have an unlimited number of staff, and at the end of the day, you have to make choices as to what's going to get you the best bang for your buck.
Thank you. Anything else?
Great. Well, why don't we move on to, we'll move on to page 6. What we've done here is just laid out the current asset classes that you have exposure to in the plans and what the core objectives of those asset classes are, and then the primary role that they play in the portfolio. I'm not going to go line by line through every one, but if you start with the top 3 investments, this is critical to the long-term return expectations of the plan, and to meet that actuarially required return is domestic equity and international equity and private equity. The primary purpose there is to provide strong capital appreciation for the portfolio over the long term. Now, there is a secondary benefit, particularly if you look over a long period of time. Equities will not hedge inflation that well in the short term, but over the long term, as inflation increases, the companies in general are able to pass that on eventually to the prices of their products. So there is kind of a long-term correlation with equities and inflation. If you look in the middle of the page, this is what we'll be talking about a bit more today, is a real assets allocation, and that's more concentrated on protecting against inflation. There is some element, depending on where you invest, potentially being additive to return as well, and we'll talk about that in the infrastructure context. The next down is real estate, which is really a form of real assets, but you have a pretty substantial allocation, so it is appropriately carved out as a separate allocation. There are a lot of benefits to real estate. There is some inflation protection element to it. There's a capital appreciation element to it, depending on where you invest. And there's also an income element to it. So real estate's a pretty attractive and a strong diversification relative to equity. So that's a very useful allocation to have in the portfolio, and you have a pretty substantial one. And then the last two categories are, or asset classes, are core fixed income, which is primarily capital preservation. When you have market shocks, when you have deflation of credit markets, that is your bastion to provide you capital preservation. There's both an element of capital preservation and capital appreciation in the non-core fixed income. You may be adding allocations to things like emerging market debt, preferred securities, which are more, they have a more capital appreciation element to it. But then there are things like high quality corporate bonds that are have more capital preservation associated with it. Why don't I pause there, and any questions on what you have exposure to currently? Great. Well, why don't we move on to real assets? So if you turn to page 8, you go through a couple pages, and there's some dividers there. So the question is, what is a real return? It's pretty straightforward when you think about it. Essentially, your investments will generate a return every year. There is a rate of inflation every year. So what a real return is the actual appreciation on the assets after you take away the impact of inflation. So for example, this is simplifying the math a bit, but if you have a 5% return on your investment, inflation runs at 2%, then the real return that you got is 3%. Just subtract 2% from 5%. Now, the math is a little different than that, but for all intents and purposes, that gives you a pretty accurate sense of what a real return is. If you look at the bottom of page 8, you can see the annual US inflation rate. We've had a pretty long period, really 40 years at this point, of pretty modest inflation. But if you look at the past 100 years or so, we have had periods of sharp rises in inflation. We haven't had hyperinflationary periods, which is something that you've seen recently in Venezuela. The case in Germany well before World War II is another example. But we have had periods where inflation has spiked up for different reasons in each of these instances. But lately, it's run very low. And honestly, our base case assumption long term right now is below where it has run since roughly over the past 100 years. It's run about 3.2%, and our expectations are about 2%. If you go to the next page, on page 9, just generally looking at a real assets allocation, there are some potential advantages to the allocation. In terms of, before we get into the advantages and disadvantages, again, this is largely what the proposal on the table is going to be, is recategorizing the natural resources allocation that you have into a real assets allocation. There are 2 reasons for that. One, it more accurately describes some of the investments you currently have, TIPS, timber, and energy, while also providing some flexibility to add infrastructure. Infrastructure would certainly not fit neatly in natural resources, so it does give you some flexibility. Looking broadly at a real assets allocation, some of the advantages, and we'll talk about it in a little more detail as we go through this presentation, are you can add some incremental diversification to the portfolio. Again, there's incremental additional inflation protection, and there is some potential for return enhancement depending on where you allocate. You're going to have a TIPS allocation included in this. There's probably not a huge opportunity for return enhancement, but in infrastructure, there certainly is. The potential disadvantages, and again, this is just broadly looking at a real assets allocation, is there is some potential for some additional illiquidity. So if you're a fund that has a lot of illiquid investments already, which I would say you don't fall into that category, but that's something to consider. And then there's benchmarking challenges, which we'll get into in a little more detail. And this is largely attributable to the fact that there's just so many different types of real asset investments that you can go into, that how you construct a portfolio will differ a lot, especially when you're comparing it. You'll differ a lot from the outcomes that your peers may have, because they just have a completely different makeup to the portfolio. If you look at page 10, some of the attributes of a real assets allocation, or it's also called real return allocation as well. This is a bit repetitive, but again, this is a very heterogeneous asset class. You can see on the bottom that there are all sorts of public and private investments that get included under the umbrella of real assets. And depending on how you allocate in your portfolio could look very different from that of peer. There are some peers that are heavy into commodities, which you don't have in the portfolio. So there's a lot of heterogeneity here, which makes kind of the second point here, which makes the risk and return attributes of your portfolio, they may differ substantially from kind of a broad asset class assumption, or again, from the return and risk assumptions that your peers are using. The third thing is just the importance of manager skill, and this depends on how you allocate under real assets. TIPS, there's not really much opportunity for active managers to add much value or detract much value. But in areas, particularly the private investments, manager selection becomes very important. So that's something to consider with allocations to real assets as well. Want to pause there before getting into infrastructure, which you kind of see in the bottom right. That's something that that may get added to the portfolio, and is one of the reasons why this recategorization is happening. Before I get into that, any questions just generally on real assets?
So is the idea that they're real meaning that they're tangible?
Yeah, I mean, it's that, and also probably more importantly that they're looking to generate a real return by hedging to inflation. So there's the inflation element to it as well.
Okay.
Any questions? Or we can move to infrastructure. Hopefully I haven't.
What's the attribute that makes it what's the attribute that makes it so that they hedge on inflation?
So it depends on the asset class, but infrastructure, for example, they're usually high fixed cost investments. So
They're high what investments? I'm sorry.
Fixed costs. So think of a power plant. It's a very heavy investment in the infrastructure to provide power. There's very little variable cost to it. So one element of the inflation protection is as inflation rises, the replacement costs for their physical assets increases along with that. So their values increase with that. And then there's also the element of cash flow. So a lot of these infrastructure assets can increase their rates, thus their cash flow with the rate of inflation. So, I mean, think about, a power company. If you have high inflation, your power bill is going to go up. I mean, they can adjust it with that CPI increase. So both on the cash flow and the inflationary nature of the valuation on the fixed assets are both a hedge against inflation.
Yeah.
Okay. Well, why don't we go to the infrastructure specifically? If you go to page 12, what infrastructure is, you'll be familiar with a lot of the investments when we get into some examples. It's investments that are essentially in structures that are essential to the functioning of society. So you think of airports, toll roads, railroads, things like that fall under the category of infrastructure. Some of the characteristics that they share, they're usually very capital intensive. There's a large fixed cost element to the business. They usually have monopolistic or quasi-monopolistic market positions that have very high barriers to entry. They're often highly regulated. Think of the power companies are a good example of that. They're relatively resistant to business cycles. Now, I guess if things get really bad, you turn your power off. But in general, there's inelastic demand. You need these services no matter what the economy is doing. They're not completely resistant, but they're certainly more resistant than general public equities. And they generally have stable cash flows. And again, those cash flows are often linked to inflation, providing that hedging attribute. Go to page 14 and 15, you can see, I'm actually going to start on page 14. You can see some examples of infrastructure investments. You'll be familiar with a lot of these. We have a couple example companies, sample companies under each category, but utilities fall under the umbrella of infrastructure. There's a lot of communications infrastructure, things like cell towers, satellites, energy, particularly midstream, which you already have exposure to, is generally falls under the category as well. Now that's more, definitely have seen more volatility there than in other forms of infrastructure, given what's going on with even before COVID, a lot of volatility in the oil and gas markets in the US. And then finally, transportation, things like rail lines, airports, marine ports, et cetera. This is a little repetitive at this point, but again, some of the benefits here are getting some more diversification, particularly relative to equities. Tends to be more volatility, but again, it depends on where you invest under infrastructure. Stable cash flows. There is a constant need for capital. Probably, certainly an argument that there's a lot of need for capital in the United States. A lot of our infrastructure is dated. And then the correlation with inflation that we talked about. There are risks to infrastructure. There tend to be relatively long holding periods. So if your time horizon is constrained, which yours is not, that can be a risk. They are not quite as attractive in terms of return relative to private assets. There is a use of leverage. Now, again, it depends on where you're investing here, but these assets do tend to employ leverage to fund the pretty hefty fixed costs that they have. There's regulatory and political risk. I think we've seen this play out more in the energy space, particularly with regard to fracking and some of the tax policies with MLPs in particular. And then there's kind of a benefit and potential drawback in terms of fundraising trends. There is a pretty substantial need for capital in this sector, but there's also the risk that, well, maybe there's a little more, too much capital chasing too few investments. So that's a risk to be cognizant of. When I pause there, any questions about what infrastructure is and some of the benefits and potential drawbacks? I want to really quickly hit on one page. I'm not going to go into it in detail, but it just kind of is a good visual of where infrastructure sits. If you look at page 15, the expected risk and return is the x-axis, and the correlation to public equities is the y-axis. Infrastructure generally is not quite as attractive in terms of risk and particularly return on private equity, but has sort of similar return attributes that can be above or slightly below equity, certainly above fixed income, with less of a correlation to public equities. So there is some, long story short, there is some diversification benefit from infrastructure, and potentially, depending on where you invest, some pretty attractive returns as well. So just to wrap things up, did want to provide a snapshot of what the first take on, and I know John will be going into this in greater detail, the adjustments to the target midpoints of the asset allocation for the plans. If you go to page 17, we will show just kind of a model of what these changes look like versus the current midpoints. But first, just quick recap on what mean variance optimization is. I think most of you are familiar with this, but long story short, what mean variance optimization, it was developed in 1952. Believe it or not, the person was actually by Harry Markowitz. Believe it or not, he was not an investment professional. He actually preferred to do his thesis on, he was using a technique called linear programming, and decided that investments would be a good potential application of that. But the basic concept is it's a relatively straightforward mathematical model in theory. What it does is you have assumptions. You basically have three sets of assumptions: one for the expected return of an asset, one for the volatility of that asset's returns, and one for the correlation of that asset's returns to other asset classes in which you're invested. And taking those assumptions, it simply identifies the optimal mix among all of the different asset classes that you are going to invest in. It finds the optimal mix so that you can maximize your return for different levels of risk. Now, it's a very valuable framework for evaluating asset allocation. It gives you a good visual of, well, as you increase your allocation to higher risk assets, you increase your return, but your volatility is going to go up. So it gives you a powerful visual, but it really needs to be supplemented with subjective judgment as well. There are a lot of flaws to mean variance optimization. First of all, it assumes that volatility is the only risk that you need to be concerned about. As you know, there are other risks. There's liquidity risks that you need to be concerned about. There are headline risks that you need to be concerned about that are not captured in this model. There's also a lot of estimation error in this model. It is very difficult with any level of precision to predict the future returns and volatility of different asset classes. And if you change those assumptions just slightly, you will see very different portfolios. So it's a good visual, it's a good framework, but it's by no means precise. If you look at a 1% increase in equities, and that increases your total return by 10 basis points, that is not precise. It is a general direction. Directionally, you're probably going to increase your return with more equities, but this is not a precise model. I think that about covers it. And then we can get into the next couple pages where we show what your current portfolio looks like when we run a mean variance optimization model, and what some of the potential changes will do. But any questions on how mean variance optimization works before we get into the actual model? Okay. Well, if you look at page 18 and the corresponding page 19, you can see what the output from the model looks like. You can see along the left the various asset classes to which you have exposure currently. And then you can see how if you look at it under efficient portfolios, the numbers 1 through 10, what this does is it takes increasing levels of risk and indicates the optimal allocation among all the different asset classes to get the highest level of return for that unit of risk. And then all the way on the right, you can see the current midpoints for the different asset classes that you have right now, as well as the proposed allocation going forward, which will be more formally reviewed in November. These are not huge changes that are being proposed. Essentially, the big change is reducing the allocation to core fixed income by 5%. John will get into this a little more. The fundamental challenge there is this is still an important allocation for capital preservation purposes, but with interest rates where they are, the return expectation is pretty dismal there. So it is important to, in order to meet that actuarially required return, not to, I want to say sandbag, but I mean, not to have more than you need in that area of the portfolio. The changes in terms of the more relative to core fixed income, the more return-oriented asset classes, increasing international equity by 1%, increasing private investments by 1%, and then the natural resources, which will change to real assets, increasing that by 1%, non-core fixed income by 1% to cover some potential investments in emerging market debt and potentially preferreds. Those are things being considered. And then cash. So cash looks a little odd, but when you think about this, and first of all, this is consolidated cash, unlike there are different pools of cash. This is overall all cash for the portfolio. And the thesis there is that, first of all, it gives you the liquidity that you need to provide for distributions. And secondarily, there's just not a huge opportunity cost there. When you look at core fixed income yielding 1%, cash yielding, but closer to 0%, but something positive, there's just not much opportunity cost there. So, it provides you with the liquidity without as much cost as it has been in the past. So that's essentially what this looks like. Again, this is not a precise science, but does give a good framework for viewing where you are relative to efficient portfolios that range from more conservative at portfolio level 1 and more aggressive at portfolio level 10. You would be increasing the expected return marginally. This is not, if you look at the expected compound return going from 6.19 to 6.35, that is not precise, but directionally, our expectation would be that you would be increasing the return by making these changes. And the big gain there, again, is taking it out of a very, very low returning asset class, core fixed income, and allocating it and spreading that to some asset classes that are expected to have a higher return over the long term. Want to pause there? Any questions about this analysis?
Mark, this is Jack. Not so much on what you've covered, but could I get you to go to page 22?
Sure.
That's your asset assumption returns on the top.
Yep.
Is that updated? And if it is, what are your thinking on some changes? Or if it's not updated, is there some things that you're looking at going forward on any of those return assumptions?
Yeah, I mean, we update ours every year, so we're actually probably just kicking off that process for next year. The thing to keep in mind with, there are two things to keep in mind with these assumptions. One is they're very long-term, and believe it, investing is one of those weird things where the long-term is much easier to predict than the short-term. I don't think there are that many disciplines where that's the case. But if you look far enough out, particularly with equities, the question is whether the equity risk premium in equities will continue. Now, we don't know what that's going to be, but if the last 200 years hold, there probably will be an equity risk premium. And then the second, the second issue is getting the relative mix right. And that stems from, if you think there's going to be an equity risk premium, there is going to be a benefit of equities having a higher return relative to things like fixed income. I don't know if that answers the question.
Well, what I'm really concerned with is just your thinking going forward on how some of these may change. I mean, I know you're going to do your whole study and all the internal things you can do, but I just want maybe your opinion. Do you see any changes going forward on these things? And then Jim doesn't have to do all that work. He just
I mean, maybe Jim can answer this. There aren't big changes from year to year. I mean, these are, when you're looking out 30 years, it would take an enormous shift in the world economy to really change things in a material manner. I mean, there are adjustments on the margins. You have a big run up in equities. You have a big crash in equities. There are certainly adjustments on the margins, but when you look long term, it's very hard to have an event that is material enough to move these that much. I don't know if Jim, you want to add to that.
Yeah, I'll take a stab at it. There's two parts to the question, and that is that directionally, which way might we be leaning with respect to various asset classes? And then the corollary to that is, does it really make a huge difference with respect to what you are? Is it likely to make a huge difference with respect to this asset allocation decision? Because you can always posit when you approach one of these decisions, well, what if your assumptions change 3 months from now? What if they change again 6 months from now? It can freeze you into sort of a total non-decision framework, which isn't really a good idea. So just to give you where we've come from, in 2019, we lowered our assumptions for equity and for fixed income. Because if you remember, in the last quarter of 2019, we had a big fourth quarter run up. So the starting point for valuation for U.S. equity was quite high. We subsequently entered the March crash, if you will, the very sudden downturn in U.S. equity and global equity for that matter. And we did something unusual. We actually made some revisions in mid-year, which we've never done before, but the change in valuation, not just in equities because they went down, but also interest rates went down even further. And so it was as much the interest rate decline that made us act in mid-year, which we don't typically do because we don't want this to be a tactical, every 3 months if something happens, do you change your asset allocation? Any more than, if I could use a metaphor, any more than if there's a storm, you go down and you change all the framing in your house. You just don't do that. You may put shutters on and do things like that, but you don't change the structure of your house. If you feel you have a good one for multiple seasons for the long run, and as Mark said, we're talking about building a house that's 10 to 20 years, and then carefully reviewing it each year to see if it needs shutters or whether it needs the roof replaced or whatever. So here we are as we approach. Mark is correct. the capital markets team at RVK is just kicking off our end of year annual review. And where do we stand? Well, we've had a major recovery in the US equity index since we raised our expectations for it at the point of the decline in March of earlier this year when COVID crashed the market. And interest rates are no higher than they were. And in fact, in some respects, they're even lower. And the Fed has signaled they'll keep them low for a long, long period of time. So I don't know where we'll come out, but I suspect that you would be unlikely to see us more enthusiastic about equity values, particularly in the US, than we were back in March. And I think that you're going to see, this goes back to what Mark said and something that we discussed with John, that the yields on fixed income are going to remain unattractive. And hence, as Mark pointed out, the biggest change in the recommended asset allocation that's heading your way is a reduction in plain vanilla core fixed income because the yields are so low and therefore the return opportunities are so sparse. So, but even if they change as we go into January, February, when we announce new ones, it's unlikely that that would dictate an enormous change in the asset allocation that would come out of our MVO modeling that we've done in collaboration with your staff. So I hope that's a little more responsive with respect to how this relates to the decision you need to make. I hope that was helpful. I'll stop there.
Yeah, thank you.
So Mark, I have a question about the data on page 18. I just want to make sure I understand what all these numbers are.
Okay.
Okay, and so I'm going to go over to the right to the proposed column, and I get the first block, the proposal of our midpoint, right?
Mm-hmm.
Okay, so then the next block, is this saying that if we adopt the proposals, then 68% of our assets would be in assets that are designed to achieve capital appreciation?
Correct.
And 18% for preservation and 0 for alpha because we're comparing the whole portfolio, right? That's all.
Yeah, well, alpha for the most part captures hedge funds. I don't think it's
okay,
but you don't have that allocation.
Okay, and then 14% designed to hedge on inflation, right?
Correct.
Okay, so now we get to the ones that I think I ask you about every year.
Carl, could we stop there just for a second? You've heard us say, and you've heard your staff say that the very low interest rates in the fixed income market, pretty much across the board, are but for funds like yourself that are trying to earn enough, as Mark pointed out earlier, to meet your actuarial return or to come as close as possible to mitigate the need for higher contributions. What do you see in that block that you just discussed? Well, you see a slight movement toward capital appreciation and a slight movement away from capital preservation. Right. That's a slightly, basically what we're saying is the markets are pushing institutional investors, all of us, to take a little bit more risk. And the question is, how much is prudent? This is incrementally more. And in the next block, Mark will point out where that shows up in the next block as well. But that's the theme that you see playing out here. And it relates to something that we've talked to you about over the past year. So I'll stop there. Mark, why don't you take him to the next block?
Yes, Mark, why don't you take me to the next block?
I'm missing I'm sorry, the next block where?
The next panel, the panel that went up
on page 18 below, once we're through where our percentage of our allocations are designed to.
Oh, I got it. Okay, so
then we come to the expected arithmetic return, which is
the expected arithmetic return essentially is the average return for the portfolio in a given year without accounting for the fact that there's volatility. The more relevant metric here is the compound return. That takes into account that essentially it takes more to recover when you have a negative return. So I mean, that essentially takes that into account. And then in the middle is the volatility. So that's the standard deviation. So
Okay, and I ask this every year. Tell me about what that number means.
the standard deviation is assuming a normal distribution. Roughly, if you have an expected return, an arithmetic return, let's just call it 7%. A standard deviation is roughly 67% of the time. It's going to be within plus or minus 11.6%. So 60, and then using a normal distribution, I think it's 95% of the time, it's going to be between 2 times 11.6% plus 7%, or 2 times 11.6% subtracted from 7%. So it's capturing, what percentage of the time is your return going to be within a certain range.
Got it.
So Carl, you could think of that 6.98 number as the next number down, that 11.6, essentially represents a bracket around it, that where the return in any given year could be that high or that low, for as Mark said, 2/3 of the time.
Got it.
So, Mr. Chair, if I could, I ask this, like you on standard deviation, I want to make sure I ask Mark. Mark, it would be erroneous to substitute the expected arithmetic return on page 18 with the actuarial required contribution.
Correct.
Those two things should not be substituted in for one another.
Correct. The more accurate comparison would be to the compound return.
But even then, we're within the bracket, and we're not getting to a level of precision that says, here's your 7.5, here's your 7.65, and they shouldn't be substituted in.
Correct. And for asset allocation purposes, if you pull back to the highest level possible, what the most important thing is you have an extended investment horizon. You have a relatively high actuarially expected return, although compared to history, it's reasonable. But to hit that, you need to have an allocation to equities, and you've done that. Assuming that the equity premium holds, which it has, and it won't necessarily forever, but it has for a very, very long period of time. Having that equity bias in the portfolio to the extent that you can stomach it over the short term, both technically and psychologically, is the most important priority. That will provide you with the strongest hedge against what your biggest risk is, which is not hitting that actuarially required return. So at a very high level, the equity bias in the portfolio is critical to the success of this plan. It's something that you've had for a while. It's why you've hit the return that you have for a long period of time. Now, whether this is indicating that the future is 6.35, we don't know what that is. This is not an accurate enough model to determine what that is. But if you reduce equity exposure, we would bet that you'll get a lower return in the long run by reducing that than not. Now, again, we don't know precisely what that is, but having that equity bias in the portfolio to the extent that you can afford it is probably the most critical thing that you have to be concerned with.
And Dan, this is Jim. I agree with everything that Mark said. I would add a couple of things. As Mark pointed out, it is the compound return that is the best comparison to the assumed rate of return. And right now, unless you all were to crank up the vol risk of this portfolio to very high levels, we don't see in the assumptions for the various asset classes a high probability of meeting the actuarially required return. Is that a terrible thing in any given year? The answer is no. If it persists for a very long time, then you either aren't taking enough risk or your actuarial rate of return is too high. Let's keep in mind what the actuarial rate of return is for. It's not for investments. It is a simple tool that the actuary uses to set contributions. And it really has nothing per se to do with the investment program. And so that when there is a gap like we're seeing today in an expected value, it doesn't mean you can't meet it even in this very next year. It means that the probability is less than 50-50. And we actually try to calculate the probabilities. And as Mark said, they're imprecise, but they're somewhere probably in the low 40% range. But it doesn't mean you can't earn the assumed rate of return. It means that the situation in the capital markets is biased against it for the time being, having a 50-50 chance, which is what you want. You want the same probability of exceeding it as the same probability equal to the probability of falling somewhat short. So keep in mind, the actuarial rate of return is a tool the actuary uses to set what they consider a prudent level of contributions. But this risk assessment, as Mark pointed out, of looking at the trade-off for the investment board of return versus risk is about the prudent level of risk to take in the current circumstances, in the current capital market environment, to try to achieve the highest level of risk or highest level of return. So you're doing a different prudent balancing than the actuary is doing over with the pension boards. He's trying to set the prudent level of contributions. You're trying to set the prudent level of risk to take with the assets that you are fiduciaries for. I hope that gives you a little bit of a framework for how these two numbers compare and how they are trying to do different things. Is that helpful?
Very much so. Thank you.
Gotta unmute, Mark.
Mark, you're not unmuted.
Thank you. Mr.
There we
Chairman, I have a question. Looking at that expected compound return on page 18 that we were just discussing or listening to a discussion about, I see that, the current midpoint is like 55 basis points below the 10-year. So maybe you've answered this question already, but it looks to me like what we're saying is the market, the anticipation for the market, because this is an optimum projection, 50% above, 50% below, and so forth, is much more poor. I would think 55 basis points is a significant number. Maybe I'm wrong, but it's poorer than what we've done in the past. Is that what I'm reading here, Mark?
I want to make sure I understand. So the 55 basis points, are you
The difference between 6.74 for 10 years on a compounded return and 6.19?
Oh, I got it. So
maybe I added wrong or subtracted.
No. Well, the portfolio, just to make sure I explain so the portfolio 10 is essentially a much higher risk profile than you have right now. So in reward for that, you're going to get rewarded for that, according to this model, by getting a higher compound return. Now, the trade-off, and I'd have to look at the individual asset classes, but the trade-off is going to be riskier. And again, the goal that you have is to maximize the long-term return expectation within the confines of the risk that you can afford to expose yourself to. Looking at portfolio 10, there's just a heavier equity bias there. You've reduced core real estate pretty substantially. And what else? It's mainly a lot more in private investments. So that portfolio is assuming a lot more equity, a lot more private equity. And, are you comfortable with that risk? And my guess is.
But we're going to get a lower return.
Right, but Mark, 1 through 10 are not number of years. Those are different.
Those are different portfolios.
Those are different mixes. Yeah, they're not years. Yeah. The number, I think.
Those are sample portfolios.
Yeah, those are sample.
I misinterpreted that. Thank you.
One being the least risky, 10 being the most risky.
Right. My mistake. I got it now. Thank you.
The other thing I think we need to point out, Mr. Chairman, if I could just make a quick clarification, when we come up with these assumptions that Jack was asking about to detail if they're changing, those assumptions are largely just what indexes could give us. So it's not capturing here trying to have active management or some managers that are trying to beat their benchmarks. So you can think of this as a baseline. If I just got the investment return of the asset class, what would I earn? It's not trying to factor in how you actually invest in equities or how you actually invest in fixed income. It's just how the asset class performs. So it's without manager alpha. So that's a quick clarification when you look at these assumed returns.
But Mark, I think your question to me sort of pointed toward a different comparison, not against any of the 10 portfolios, but is this compound return lower than you've achieved over the last 20 years? The answer is yes. But that's fact, the last 20 years, this is an expectation. So we have to be humble about it. But in point of fact, why would we be more pessimistic about the next 10 to 20 years? And the reason is, if I showed you two charts, one of what has happened to equity valuations over this period, they're extremely high relative to historical levels. And if I showed you a chart of interest rates, you'd see that they are historically low. So we have the two main asset class drivers for your portfolio situated in a point in time where they're not as attractive as they've been in most years over the past 20. So it would be imprudent for us looking at that to try to tell you that the future was really rosy, because we can't demonstrate that given the current interest rate levels being so low and therefore yields being so low, or equity valuations being so high. So that's why you're seeing a 6.35 and not a 7.5 or an 8.0. I hope that is responsive to some of this.
That's exactly what I was driving at. Thank you.
Mr. Chairman, can I just make one additional point?
Sure.
So RBK mentioned this at the beginning, and I just want to hammer it home a little bit. I mean, mean variance optimization is a great tool. I think this is a good process to go through, but it is a very imperfect process, and they've listed on 17 a lot of the shortcomings here. You know, we do not work in a world where we get a normal distribution of returns. It never happens. I mean, we have these events that we had in March. We have, you know, events in 07, 08 that we go through that are far outside what, you know, this model would suggest. There are a lot of assumptions here, as we've talked about. They're generally backwards looking. Correlations don't hold in this environment. There's just a lot of things here. This is a great framework to do this with, but what I'm getting at is I don't want people to take away too much from the idea that it's, you know, 6.35% return. It's not a real number at the end of the day. You know, we're looking forward, and I'll give you the best example here for me is fixed income. Fixed income, we've had a long history over the last probably 40 years of declining interest rates, you know, negative correlation to equities, all of these things. There are periods of time in the distant past where those correlations didn't hold. You know, we're probably closer to that than we are what we've experienced over the last 40 years. So there's just things here that the model can't capture.
One of the funniest stories about, I'm sorry, go ahead, John.
I was going to say, we would agree with everything that John said. You know, to use another metaphor, since I'm no longer on the chairman's budget here, you know, if you were trying to go to Oregon out of St. Louis in the 1800s, you probably had a map that was rather sketchy, but at least it told you what general direction to go in. And if you kept going back to the map and reoriented yourself, it got you to Oregon. But it looked pretty sketchy if you've ever looked at those historical maps. They're nothing like the topographic maps we have today. So you might look at this and say, we need some map to guide us going forward, and for John and his staff to work around, as they work within the ranges around these midpoints, and deal with the circumstances that John indicated, there still needs to be some sort of general direction, some even a rough map of what the portfolio ought to look like if it's going to have the risk return characteristics that the board wants. This is a kind of a touchstone for managing the portfolio, but John is right. It's not a quantitative, you can book 6.35% somehow. That's just not going to happen. We would agree with him. Mark, I'm sorry I interrupted you.
I was just going to say a funny story about mean variance optimization. Its original use was to optimize capacity utilization. And one of the applications was the airline industry. And when you think of the limitations that affect the use of MVO in investments, you have these sudden shocks. The same thing happened. It was the same. It was a similar dynamic in the airline industry. I mean, just look what's happening today. It's like you can plan. This is the relationships among asset classes are useful in benign environments, but then when you have shocks, the wheels come off. And it's just kind of funny that was one of the original applications of linear programming.
Don't say the wheels come off, Mark.
Okay, well, let's,
Carl, I have a
so
question.
now that we've clearly established that RVK is guaranteeing 6.25%, or they'll make up the difference, we're sort of behind and need to move on to John's presentation. We had a break scheduled in here. What's the pleasure of the group? Go ahead.
5 minutes.
Let's do 5 minutes and then instead of 15 and get back at 22.
Okay, we'll be back at 22.
Okay. We're ready in the conference room.
Okay. And I think we're already online. We're behind tab 6. And John, take it away. But let me say before we do that, even though it got us a little bit behind schedule, that was a very valuable discussion. Thank you, Jim, Mark, Becky. It probably set this up very nicely.
We hope so.
John?
Good, this should be easy then, right?
Sure.
His last words.
All right, Mr. Chairman, members of the board, on tab 6, you see my memo there. I went into a fair amount of detail here, and I'm happy to attack this however you would like. I guess if there's no objections, I can just step through each of the various asset classes and any proposed changes that I have here, or if you feel comfortable and you just want to start asking me questions, that's fine too. Preference there, or if not, I'll just.
Well, you're proposing changes consistent with what was what we were just told by RVK, correct?
Yeah, so maybe to frame the process here a little bit, the staff and I had initial discussions, had each of the directors propose what they would do in a perfect world if they were king and got to pick the asset allocation. We did not all agree, so with the goal here with this year was not to come to some kind of consensus. I just wanted to hear everybody's honest opinion on what they thought was best. I guess I would broadly frame that as I probably had kind of 2 camps broadly. One camp was probably much more aggressive than what I'm proposing here. One camp that was much more conservative than I was, and I'm probably kind of in the middle. We then took that to RVK, had discussions with them. They ran the mean variance optimization that you saw there to get us those results and help frame the issue for you as well. But it was a good discussion across the board, both with staff and RVK. As they said, we had multiple meetings with staff, multiple meetings with RVK. I think it went well. I think we got to a good result. And with that, maybe I'll just go through kind of each of the changes here. I mean, you see on the first part of my memo, the summary of the changes in the table. But maybe I'll turn just to page 2 of the memo, the asset allocation changes. So as RBK already kind of framed, really the crux of this change is all about reducing core fixed income. And I think the thought process there is pretty straightforward. There's not a lot of return in core fixed income at the moment. And I would argue that, as we were talking about a minute ago, the decline in rates that we've seen over the last several decades has been a tailwind to performance there. So as equities have fallen, typically the Fed has come in, cut rates to get the economy going again. We've probably gotten that somewhere close to its logical conclusion. We can't go a lot lower, although we certainly see negative rates in other countries, so that's theoretically possible. But it doesn't look likely that rates are going to change a whole lot going forward. The Fed's been pretty clear here recently. And again, this is a long-term thing, so I don't want to place too much emphasis on that. But if we just look at kind of 07, 08, we saw the financial crisis at that time frame. The Fed cut rates close to zero. There was an expectation for those of you that have been on the board for a while, every year we'd come back and say, oh, rates are going to go, they got nowhere to go but up. They're going to go back up. It took us 10 years to where the Fed started to raise rates. And then pretty quickly, we find ourselves here again with COVID. We've gone to zero again. I'm not saying it's necessarily going to take us 10 years again, but it's not out of the realm of possibility. So I think it's a logical move here to reduce core fixed income. And I think when rates are at zero, close to, as you know, with bonds, if interest rates go back up, the value of our bond portfolio goes down. And really, when you think about it, as the Fed has reduced interest rates to get the economy going, the equity markets have, enjoyed that and said, oh, you're going to boost the economy, you're going to make lending cheap and things. So that's been a driver for the economy as well. So to the extent, or for stocks as well. So to the extent that rates go up, we could have a situation potentially where, stocks are going down and bonds are also going down because rates are going back up. Possibly even because the economy's getting a little bit better, which is a little bit of a paradox there in a way. So long story short, correlation may not be the same as what we've had over history. So you might not get the protection and enjoy the kind of counter cyclical performance from bonds that we had from equities over the last many years. So questions on kind of the reduction in core fixed income, I guess, off the top.
Based on your argument just there, why didn't you go lower? I mean, I know you put an explanation in there, but that sounds counter to what you just told me.
Well, we don't know the future. And I could be wrong. Yeah.
Really?
Rates could go lower, rates could go negative. You could potentially have a situation where rates go back up very quickly, probably not for good reasons. I think there's still a benefit there in terms of liquidity. Certainly the treasuries that we hold, as we know from, kind of these various crises that we've been through over the years, that you get into some of those situations, treasuries are oftentimes the only thing really that you can sell without, big penalty. You can probably sell stocks because they're liquid, but probably don't want to if they're down 30%. So I think it's still prudent to have, a good allocation there. And I guess I would also note that, 15% is the midpoint. So that doesn't prevent us from going down to close to 10, given the current range that would be suggested there. That's your question?
Yes.
Okay.
I was disappointed that you can't see the future.
I'll work on it.
I'm disappointed, I understand.
Well, I'm not the first one you've disappointed and probably not the last, Jack, so. So number 2, moving on, changing natural resources to the real assets asset class. So, we heard quite a bit about that from RBK in broad strokes there. Essentially this is a name change, if you will, okay? Frankly, Go ahead, Bruce.
Yeah, just a minute here. Because I want to add, since you jumped over to the change in the designation to that real asset class, I wanted to ask about the cash equivalent, the change in the midpoint on the cash equivalent. Are you going to talk about that at some point, or should I ask about that now before you go to?
You can, I will get to that. I was just gonna go down the list here of each of the changes. So that one, I will get to that one for sure, but I can skip to it.
Okay, I'll just hold my question then.
Okay. So the real assets asset class, I guess I view it primarily as a name change. Real assets would be a more common asset class that I would see and from most of our peers. I don't really see anybody out there with the kind of the natural resources designation. I think it kind of a little bit more cleanly encompasses the basket of sub asset classes, I guess, that we are trying to capture there. It does add infrastructure into the mix. So infrastructure has sort of been something without a home. It's not to say that we can't invest in that currently under the current structure. And in fact, would argue that we do have a couple of infrastructure investments already. So MLPs would be one. So the natural gas, oil pipelines, we have some investments there. Those would clearly be infrastructure. We've got one with a power generation kind of private equity type firm that's in the private equity bucket, I believe. Maybe it's in natural resources. I can't remember at the moment. I guess it is. So, you know, we've got some there, but I think this makes it a little clearer. And one of the reasons here is that I kind of want to make this more specific is that natural resources broadly has been one of those strategies or asset class areas that's sort of fallen through the cracks. Sometimes it doesn't offer enough return to be kind of in the private equity bucket in Michael's world. So they might not, you know, want to sign up for a strategy that, I don't know, say it's going to give us 10 or 12% or something, or even, you know, 8%. That might be an attractive return overall to the portfolio. Might have some steady cash flows associated with it, but kind of doesn't really hit that private equity like return as RBK showed kind of on their little chart there. So it sort of falls in between. And subsequently, we probably haven't pursued some of those opportunities the way that we could. And I do think that infrastructure, as Mark laid out, it offers some diversification benefits and some cash flow aspects in kind of some of these mature industries, like, you know, power, where you're paying your power bill and you own the power plant or something, and you get that steady cash flow every year and you're earning 8%. It's kind of bond-like, you know, so it's kind of a substitute in a sense for fixed income for some of these types of strategies. So I think it can be a good fit and can offer an attractive return. So it's sort of something to bring it to the surface a little bit more, give us a bucket to put it in. I don't really view it as a big change from what we're doing today, other than it makes it clearer, and it'll clearly be in Ethan's world. Then we know who does it, you know, will be easier to pursue. I'll stop there. Questions about that or concerns there with that particular change?
I have a couple.
Sure.
And it has to do with the investment statements or policy statements or objectives and guidelines, the proposed the objectives and guidelines.
Okay.
It looked like under the old natural resources policy, we permitted investments in water. That's being stricken. Is that just?
I just struck it because I felt like it was kind of within the commodities, you know, all other commodities, I think is how it's still phrased there. I don't think we have I don't know that there were enough individual opportunities there. Like I felt like we needed to break it out. Not really. I'm not really taking it off the table. I just didn't feel like it deserved its own.
Okay. And then the next question I have is is in the investment statement, is commodities the right word? Or because I thought we have specifically rejected what we've traditionally
So,
commodities. I mean, hog bellies and.
yeah, it's a broad, commodities is a broad statement there. So I think of commodities, and I kind of phrased it as commodity related strategies, I think, within part of the investment policy statement there. So we have clearly all of our energy, oil and gas type, private equity type structures that we have would clearly be commodities, I guess, in my mind, or commodity related strategies. They're currently in the natural resources bucket. It's a broad, it's not that we're going to go out and, as you say, buy pork bellies or something necessarily and, get a commodity, that would be a completely different type of strategy. If we did, I guess if we decided that that sort of thing was appropriate, it would clearly go in this real assets bucket. But we haven't done something like that at this point.
Well, but I think we've gone even further than that. I mean, years ago, we had an educational program on commodity trading.
Correct.
And made I thought, a specific decision. We didn't want anything to do with that because we didn't have expertise and staff, et cetera, to do with it. And I think when it comes to a investment statement, we ought to be careful that it can't be read to include that.
I hear what
Not
you're
that I
saying.
have a better word. That raised a concern.
I understand your point, Carl. No plans to go out. So I agree that we don't have staff to do that in-house. So if we were to get into that world, you would probably go out and hire a CTA, which is a commodity trade advisor. It's basically hiring a manager that would go out and trade that type of stuff for you. No interest in pursuing that or doing that at this point. If we did, I guess much like emerging market debt or preferreds or something like that, we would certainly come to the board and raise the issue prior to pursuing some strategy like that. I don't know how to, I guess, I'll think about it. I don't know how to phrase it differently necessarily in the policy statement to
Mr. Chairman,
completely exclude that.
Well, I think that, having been involved in the commodity markets a little bit as a wheat farmer, using them to hedge, I think the distinction that John's trying to make, and I probably won't make very well, but I'll take a stab at it, is the difference between being involved in the commodity markets, the use of hedging and futures contracts, or involved in that market, as opposed to being involved with the products that are in that market, say investment in a copper mine or investment in a grain elevator. So I think that's a little bit of the distinction there. There's a difference between the commodities markets and the commodities that are traded in those markets. And I think rightly, you made a decision a long time ago to stay the hell out of the commodity markets, which I say, great. But the commodities investments in the products that are traded on those markets is a different thing. So I don't know that I said it very well, but there is a distinction there. In fact, I didn't say it.
We're not making a decision on this today. I just raised that as a concern. We've had these issues where we look at our policy statements and we end up places where we didn't necessarily want to go.
And part of the reason that
be careful we don't have that here.
Yeah, part of the reason that I offered that, Carl, is that I wholeheartedly agree with you on making sure that this isn't a reference that opens the door to being in the commodity markets.
Okay.
Sorry to belabor it.
No, I think that, I appreciate that. That may be the distinction. I don't pretend to know it anywhere near as well as you do. So, Mark, did you have something?
Well, no, I was just gonna say, as uneducated about this subject, but I kind of see John's dilemma, because it seems to me that in the commodities market, even though the trading is in futures and options and that sort of thing, I mean, you theoretically are buying the commodities and then trading the right to buy the commodities in these futures. So, I mean, literally, you are buying commodities, but that's not the markets we're talking about. So I would just leave it up to John to come up with some phraseology that's not as all encompassive, and maybe it's just what he's got there, basic goods such as, and leave it at that. But anyway, I just wanted to make the point that, I mean, literally, I think if you even talk about the commodities market, you're buying them. I mean, somebody's got to buy them, or else it doesn't all work. You know, it's like buying stocks or trading stock options and futures. So that's my 2 cents.
And then the other question I had, and this may be too early for you to have an answer for me, is that how are we staffing this? The new asset?
How are we staffing real assets and infrastructure?
Yeah, would that, I mean, is that?
It'll fall in Ethan's world.
Okay.
So he's doing natural resources now. He would be doing the infrastructure aspect of it, which honestly, we, as I said, I mean, we already do it in part. Most of the infrastructure type assets that we would be talking about here would be, you know, private equity type structure. So this isn't unfamiliar territory or anything. And we've already got a couple on that we're looking at currently that, you know, frankly, Michael and Thomas kind of started. And if this gets approved, it'll probably just get passed over to Ethan. He's in the loop. And, but this isn't that unique.
And what about, would he be buying the tips, or would someone else be?
So John Ramasco and fixed income team would continue to do the tips portfolio. I know that's a little bit of a crossover between worlds there, but obviously, you know, as Mark talked about a little bit, I mean, the tips portfolio, it's not like it's going to be high return. There's not a lot of opportunity to outperform there. You know, clearly we have a very low cost solution there. So, you know, they would continue to manage that, and that's pretty minimal time they can work with me and Ethan as in terms of, you know, sizing of that portfolio or any changes that we needed to do there. But, you know, and I don't have any issues with a little bit of breaking down the silos between the teams is, I think, a good thing at the end of the day.
Thank you.
Carl, I have a question. This is Maggie.
Yes.
So John, I see in the real assets asset class that you're taking the midpoint up 1%.
Yeah.
Yet you're adding 1.3% from the tips that you're adding to it. So where are we currently, I guess?
Yeah, well, currently we're about 3%. So the current midpoint's 4. So if we add the tips in, gets us to about the current midpoint. So I'm kind of bumping it up with the anticipation that we'll add some infrastructure assets. That would be the focus going forward. Ethan's talked about a few times, I think, more recently, that, you know, the oil and gas, energy type related stuff there, we've got a pretty good chunk of that. You know, we're not really interested in adding so much there. So the focus would probably be going forward, more likely to add to the infrastructure type space within this portfolio.
And I was just wondering if that was enough.
Yeah. So that gives us a little bit of room. Yeah, absolutely. Other questions on that, on number 2 there, I guess.
I went to number 3. I apologize.
Oh, that's okay. Oh, that's the next one. Yes. The increase in the midpoint. Good segue, Maggie. So yeah, just moving that up. That's why you asked about, you know, who's going to manage the tips portfolio. You know, I would note, RBK talked about this a little bit. I think within the 3 areas that, you know, broadly we've delineated there under real assets, the commodities, inflation-linked bonds, and infrastructure. infrastructure probably has the most attractive return profile. Mark talked about that and kind of the long duration of some of those assets and things. It actually fits reasonably well within a pension type portfolio there. And if you look kind of at I saw a fairly recent study that came across, I think from eVestment, that showed all the different consultant estimated returns for, similar to what RBK showed for MVO. But if you break it down a little bit further for infrastructure in particular, the average return for infrastructure from that survey from all the various consultants was about 7.5%. So clearly a little bit, higher return, certainly, as opposed to say tips or something like that. Other questions on 3, increasing the midpoint there of the real assets? All right, 4, increasing the midpoint of international equities by a percentage point. Kind of a nod to where we're at, or where we've been, I should say, maybe for quite some time. As I looked back, we've probably been around 17%, give or take, for, I don't know, well over a year or more. Kind of a nod towards, RBK's presentation. We talked about their return assumptions there, which are consistent with, kind of what we see across the other consultant universe and things, that international equities return expectations are a bit higher there, just given what's happened with domestic equities. Now, one of the things, as I talked about before, we don't know the future. I can remember for at least the last decade, probably, we've been talking about higher return assumptions for international equity, and it hasn't really panned out. So this is kind of a, no change in some ways. But, domestic equities have continued to get richer and richer in some ways. There's some, I don't want to get too much into the weeds, I guess, but, currencies and things, the dollar has started to weaken, and you start thinking about the budgetary aspects of what we've done in terms of stimulus dollars and things that could weaken the dollar over time. So there's some logic to bumping that up just a little bit. Don't think it's a big move or anything, but happy to answer any questions on that as well. All right, seeing none. Increasing the midpoint of private investments from 14 to 15. I think this is consistent with what you've heard from us over a number of years, where we've kind of steadily moved private investments up a little bit. We've also kind of continued within that structure to think a little bit more about private credit, private debt. And so this is really a little bit of a continuation there. And again, just looking at where can we get return. This is an area that we think we can get return. We've obviously got a long-standing history with being involved in this asset class, and it's been a big driver of what's gotten us to where we are today so far. So again, a small move here. That said, the other, I guess, tweak here is that proposing to expand the size of the range here a little bit. And so I just left the bottom of the range the same, moved the top of the range up 2 percentage points to get me to that 15% midpoint. 2 reasons here, I guess. One is, again, maybe a nod towards our increased weight here within private investments overall. But also, it's an area where we can't really affect our positioning within the asset class. It's really a function of what's the public equity markets doing. As they rise or fall, our midpoint will adjust quite a bit, as we saw perhaps in March. And so given that, and given that we've kind of continually upped the size here a little bit over time, I think it makes sense to have just a little bit broader range here, so that, I know in March, for example, the board pretty much said, hey, we're not too concerned if we breached a range because the equity markets dropped so precipitously. But to kind of avoid that, I think we might as well give ourselves a little bit more room. The size of the range here is consistent with what we've got we'll say, the equity asset classes or domestic or international or something. So I think it makes sense, and it's not not a big move. I have questions about that.
I have one that's, I think you may have answered it there with the range discussion, but why aren't you more aggressive moving that up higher?
Yeah, so I have a few directors that would love to, move it to the moon.
And one board
and one board member, apparently. For one thing, we can't get there in short order, so we've been steadily moving this up. But as I think RVK will tell you, it's in particular an asset class where I don't think we want to go in and say, well, we were allocating 350 million a year. And next year we're going to allocate 600 million so that we can move up, because we want to have pretty steady pacing here, because we don't know, what year is going to be good, what year is going to be bad. And so we've continually kind of incrementally ratcheted that up. So I don't think we can get there quickly, even if we were to raise this much higher. It's not going to happen in short order. So we've been steady and slow and thoughtful, I think, about the way we've approached the asset class and how we get in and who we get in with. It's an area where I don't want to prejudge the future. We'll see what happens as we go along. Perhaps we'll come back and continue to ask for more, but we've pretty much been chasing the midpoint here for a lot of years, and so I don't feel like we need to move it higher. And I would have no qualms about, midpoint's 15. So if we get to 16 or 17 or something like that, that would be fine. I think that's probably enough. And at some point or another, I don't know where it is, but I'm comfortable with the liquidity and being able to pay benefits with the public securities that we have now. We need to continually be cognizant of that as well, because the markets aren't always favorable, and certainly this is an asset class where we're in with the deal, and we're in for 10 plus years probably, and you just got to live with it.
Yeah, this is Jim. We agree with everything that John said. You're not constrained right now. Your pacing needs to be steady, has been steady. You actually run a very good privates program. It's very cost effective, but you haven't done an asset liability study in a decade. And it would be wise for you not to assume that you can take on substantial increases in illiquidity without testing that proposition well first. Because as John said, this is not a thing that you can reverse easily. Once you pour a lot of money into privates, you're in it for a long period of time, regardless of what the market circumstances are. So we wholeheartily agree with John's response to that question.
I'd add that I think since this is an annual exercise, there will be logistic issues in the coming year for sure. So I don't think we can send Michael on the road a whole lot.
No, that's going to be one of our constraints here in the near term.
Yeah. Okay.
All right. Number 6, increasing the midpoint for non-core fixed income. Again, just a higher return assumption here than core fixed income. As you know, we're moving forward with preferreds and emerging market debt. I guess maybe as a side note, we're probably getting pretty close on preferreds. Hope that I bring that to you, or that Randy does, I should say, I guess, at the November board meeting, maybe EMD as well. That's a little bit further out, but we'll see how that goes. But that in and of itself will kind of get us towards the midpoint here as we start to fund those managers. So I think just another good place to find a little bit of return, still get some diversification effect, move a little bit away from core fixed income.
So John, can I ask a question? When you bring this back in November for us to vote on, will you give us some idea of where we are currently in all of these?
Sure,
asset
and I can
classes?
give that to you now if you would like.
That's not a big deal. I just think it kind of helps my brain understand where we are and why we want to go to work.
You know, it's pretty interesting, just the market moves that we've had even over the last few months. It can move mostly because domestic and international equity, as they move, so move the other asset classes. And so it can, it's probably moved a couple of percentage points up in domestic equity more recently, as we've had a pretty good run, which then reduces the size of, say, privates and real estate and other things. And
That's why it'd be just nice to look at it, John.
but yeah,
when you have
absolutely,
this-
I can provide
Just a
that.
snapshot of that's what it.
100%, I can do that. Other questions on that point? And then cash. So Bruce, suggesting moving the midpoint of cash from 2 to 3%. As Mark said, I think there's minimal sacrifice here to holding a little bit more cash. We're just not giving up much return. And so to the extent that we are reducing core fixed income, there may be times at least have a little extra flexibility to hold some additional cash. We have done that here more recently as kind of equity markets have run up. I've been closer to say 3% than I have 2. It's not to say we'll do it all the time, but I think it made sense as we felt like things were getting a little expensive in some areas. So I think it's just helpful, as we got into, say, March and things, being able to boost that up a little bit more, or, perhaps hoard cash flows that may be coming in if we think things are particularly uncertain. It would be nice to have the flexibility to do that. And I do just want to remind everybody that, I know we talked about cash a lot several months ago. We do not have significant cash in any of the various asset classes. So there's not a bunch of other cash laying around in other places. Yes, there's sort of cash flow, we got to pay a certain amount of fees, or there's cash that moves in and out to fund certain things, but operations has done a great job of doing that, at least probably we're looking at it every single day, but probably weekly, and certainly monthly, they're making those changes to kind of adjust for flows that we know are coming in. If we've got money moving out the door for a private equity deal or coming in from other places, they adjust those things regularly. And so I think we have a good handle on it, and has been smooth.
Yeah, John, and I appreciate that. And I guess, that was an education. One of my many educations here, hopefully over the last year and a half, was watching that process of taking the cash that was scattered all over the portfolio and pulling it into one place. I guess the increase from 2 to 3% didn't catch my eye as much as the change in the range from 4 to 6%. And obviously a midpoint is a midpoint, but it just got my attention that after what you'd been through over the last year to try to get the cash in the overall portfolio, not only rounded up in one place, but down overall, that, it just seemed like, do we really want to raise that range back up in view of what we've gone through in the last year and a half?
Yeah, I hear what you're saying, Bruce, and I figured that was probably going to be a question. I think it would be unusual for us to be much above the midpoint here within cash, but not out of the realm of possibility should we get into a more stressed environment, I would say. So if you saw, cash in the portfolio above 3%, or much above that, it's probably a question you should be asking me, why? What's going on in the world that makes you want to hold that much more cash? But I can see where it might be, particularly in more stressed environments, something that we might want to have the option to do. But I wouldn't call it probably a typical place where we would. And some of this, to be honest, yeah, I'm trying to make the midpoints add up to 100. So there's a little bit of that. Maybe I would have said 5, but it's just easier to have it add up to 100. So.
Okay, appreciate it. Thanks, John.
Yeah. So the other 2 additional changes here would be the benchmark changes. And loath as I am to talk about benchmarks, I will.
Where would we be if we didn't have a board meeting and
Right?
didn't discuss private investment benchmark?
So.
There's the chairman's response there.
So the first one is the private investments benchmark. I just think that it makes sense to acknowledge the differences, and this is somewhat similar to kind of the infrastructure conversation. So private equity and private debt tend to have somewhat different return profiles and perform somewhat differently. We have told you, I think, over the last couple of years, at least probably, that we've made some effort to increase our exposure to private debt, private credit. In doing so, that may reduce our overall return because private equity has usually got a somewhat higher return profile than the private credit. And it probably wasn't really that big an issue when that was a very small piece. It's now probably, it's approaching 20% of the private investments portfolio. If memory serves, I think Michael's kind of shooting towards, say 70-30. And so as that grows, I think this makes it both a fair representation of kind of the risk return that we're looking for. And I don't want to disincentivize, similar to infrastructure, the idea that, well, we're not going to do that private credit deal because it's only returning 12% and the private equity deal is returning 15%, even if maybe we think, well, the risk is substantially less with private credit. And you could just have some bad signaling there, I guess, if you will. Not that we have made decisions based on that at this point, but I just think it's a fair, more realistic representation of the risks and the rewards that we are looking to take in this portfolio, and that this will capture better. It won't really change anything functionally. We're going to still report up to the board private investments as an asset class. We're not going to, but it will also make it a little bit easier for us to break all of this out and kind of, I think, over time, as that does become a bigger chunk of the portfolio, report things to you and allow us to see into the portfolio and keep track of all of that type of stuff. So I don't think a big change here, but happy to answer questions.
So my question is to Becky, Mark, and Jim is how silly are we making yet another change in our private equity benchmark?
I mean, I don't think it's silly. I think it's sensible the way the contents of the portfolio have morphed, and you're making it a change, to reflect that. So, you don't want to get distracted too much by benchmark conversations. And I think you all recognize that these are imperfect benchmarks no matter what you use. But, in theory, the fact that you have more in credit, this does seem like a sensible change.
So
And
Carl,
the general philosophy is, it's still an index based on, you have a marketable index for this private world and the equity component. It's not changing that component. just recognizing that there's something in the private debt world that's a better comparison, although these are going to both be imperfect. So we appreciate it. It just feels like an evolution of benchmarking rather than a change of philosophy in this case.
And Carl, we did have that discussion because you're quite right about, I don't want to make, changes for the sake of change, and it does create some issues as far as, having that long track record, I guess, if you will. Not that we can't, we'll link everything together, and State Street's more than capable of doing that. I think this is just getting it to a place that we think is appropriate. And I hope that we don't talk about this again for the next decade.
15 years.
15. Executive director says 15.
Question I asked for sure.
Not before January 3rd, 2035.
Sounds good. I'm out then.
Yeah, we're out. Our VIVA's in effect at that point.
All right. Other questions on that change? All right, seeing none. And then finally, a benchmark for the real assets portfolio or asset class. A similar thing here. This is, just an area where I hope that we are setting this to what we believe is right, and hopefully we don't talk about this again. It's a very imperfect benchmark. Went through a number of iterations here of how we might approach this. Felt like going with kind of a third with the three, publicly available benchmarks here was an appropriate mix. But it's, it's going to be imperfect. And again, hope that we set this and forget it for 15 years. The only other comment I guess I'd make on this one is, we did talk about, and both approaches here would be common for our peers, I guess, in some way, shape, or form, although I wouldn't say there's really any consistency to what peers do within this type of asset class. It's quite variable, maybe more so than most, but there's a lot that would have kind of a CPI plus type component. The thinking, so I think we'll look at that as kind of a secondary benchmark, just to give us information and feedback as to, at the end of the day, we're kind of an inflation linked type investment. But it harkens back to me to kind of the S&P, 1500 plus 4 or whatever we had for private equity back in the day, as a lot of you will remember. And we remember the issues with that. So felt like that was less ideal as the overall benchmark, but maybe something that we look at and consider just to give ourselves, some additional feedback here.
Yeah, John's right. Other peers do say we're going to put this real asset portfolio together and we want to beat inflation by this percentage, 2, 3%, whatever is appropriate for that particular benchmark. But the problem is that CPI doesn't really have, as much as it varies up and down, it's very small variations. And so you're dealing with an index that really doesn't have very much variability in it compared to returns that are going to be variable in these asset classes. So it was just setting us up for a mismatch for quarterly reporting. But as John said, for a long term, did we accomplish what we wanted to in this portfolio? It will be a useful secondary comparison. It bears no resemblance to the day-to-day actual experience of the asset class.
So will that be reported to us then? Is this, when you do your quarterly reports, you report how we do against the benchmark. Will you report against a secondary one, or will that be part of an oral presentation, or is that something you'll check in once a year on, or how will we
could do it either way. Some clients have both reported in their report. So the primary comparison is against the third benchmark, and then you'll have a secondary benchmark. We can do it that way. We can talk with John how he'd like to see it reflected and how you'd like to, but that would be what we would typically do is just put it in your performance report so you get a chance to see it regularly.
Kim, I don't know if that's the best idea or not. I hope you'll work with our staff and
Absolutely.
Yeah, we haven't really figured that out, Carl, I guess, just answer your question, but happy to do it either way.
okay. Questions? John, do you have anything additional?
I do not.
Questions? I guess, are you looking for preliminary feedback here?
I think to the extent that you want to see any changes, absolutely. And I'm happy to take that either now, or if you think of questions later, prior to the November meeting, happy to have those conversations offline as well. But certainly would be helpful, I guess, to the extent that you can give it, what your thoughts might be at this point.
I'd like to just say that I'm very pleased and I would certainly vote for this and without any changes.
Can I just follow up on the commodity question? Do you want John to take a stab at some different language? Are you good with frozen orange concentrate? I mean, I think that Carl's point is very legitimate, that there was consideration by the board. I think with John, there's certainly a great level of trust on all of our part, but if there's, we don't want to find ourselves in another diversifying strategies place, certainly. Not that you get us there.
The way John was using it, it's appropriate. It wasn't a commodities market, it was commodities. And when you look at the definition of commodities, it includes water and includes all sorts of raw materials, gold, oil,
Yeah, it's the issue with the real assets portfolio or asset class, commodities as a sub-asset class, is that, it's just a very broad, there are a lot of different types of investments and strategies that you could put in there. And so I understand the concern. I understand, what you're saying. I guess, my bias would be is to kind of leave it the way it is and to just pledge to you that if we're talking about getting into something very new like that, where we were going to hire a commodities, futures manager type strategy or something of that nature, where, clearly you've expressed, less comfort and well aware that we probably haven't gone there, we'll come to the board and have that discussion prior to implementing something like that.
Well, my concern isn't that you're going to go off the rails here, John. I want to make sure we're clear on that. My concern is that and I don't have the answer to it, but my concern is that if there is a better word, that maybe we should use it, because this word means something else, at least to me. And if you tell me I'm wrong about that, I understand. If you tell me there is no better word, I understand that too.
Okay, well, let me think about it, and I will see if I can figure out a better way to phrase some of this to make it more explicit that we're excluding that sort of thing. I'll come back to you.
I think I echo what Jack said, and in terms of not only the result, but also the approach, and also, I guess I'd like to also say the way it was presented to us this year too. Excellent. Thank you all.
So are you talking
Anything
about
else?
those collectible plates?
Always.
Anything else from anybody? Are we, it looks like we might be at the end.
We are at the end. We'll have the conversations, I guess, in terms of follow-up. We'll have the conversations with RBK on how we present the secondary benchmarks to all of you. I will send you all you should all have the new org chart as Terry requested this morning in your email.
Are the pictures on there?
It's not the picture one because we don't have pictures for everybody, but we will get pictures for everybody and get you a picture one. And November, we have the legislative session discussion, resolution 217 authorizations. Director Schwinden and Director Graham will be here to discuss the evaluations as well as the relationship generally. Asset allocation range approvals. We'll have the final SOC report. We will have the annual report for all of you to consider, as well as the financial statements.
Is that all?
That's what I was thinking.
It's a
Geez.
2-day meeting,
And that's the 18th and 19th.
18th and 19th, yes.
And I,
And we will have same, I'm sure we'll still be under the same travel restrictions, so.
Yes, I mean, I'm thinking that we'll stay with this format unless things get worse or we get other directions from on high, but it seems like this is working well and we'll have the technology, the few remaining kinks worked out, I'm hopeful, so we'll be able to accommodate a little better.
can I just say, I'd like to make sure the board acknowledges the extra work Herb did for us. I thought that was excellent, and make sure he knows the full board understands that and thanks him.
And I guess before we adjourn, related to the technology, is there anybody have anything about how we could do this better or problems that they saw today that we can work on, anything like that?
I think we're gonna work on Terry's iPad and just make sure, if we gotta get her a Surface for board meeting days, that we might do that, so she doesn't have to call in and do the other. And then certainly if any of you are gonna be zooming in and need a computer for a day, we can accommodate that. If you need cameras or headsets, we've got those. We can.
They bought Chromebooks for the Impera board, and we use them for our Zoom meetings. Can't do anything else with them,
Yeah,
but it's okay,
so depending on your,
Prime Day, we can probably get them.
yeah, it's Prime Day, we can go buy some. Uh,
It's a prime commodity.
With the return of the pay guarantee, right?
Things we
We've
buy.
gone off the rails.
Well, with that, I think, are we ready to adjourn then? Does anybody have anything else for the good of the order?
Nice tie, Carl.
Yeah, well, I wore, my alternative tie.
Let's see his socks.
So anyway, with that, I guess we are adjourned. Thank you all. Nice to see you.
Thank you.
Thank you,
Thank
Mr.
you.
Chairman. Thank you all.